When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg Markets. Welcome back to the program. I'm Anna Edwards in London. Now, the Binance CEO, Changpeng Zhao, has told Bloomberg that the company is aiming for a roughly $1 billion fund for the potential purchase of distressed assets in the digital asset sector. CZ, as he's often known, spoke exclusively to my Bloomberg colleague, Haslinda Armin, about the fallout from the collapse of rival FTX.
We'll see a little bit of contagion. Whenever one big player goes down, especially a trading platform, there are many other people or institutions with money on the platform. I think we've seen Genesis halting withdrawals. I think there probably may be one or two more, a couple others. I don't know how many. But each time there's cascading effects, the effects become smaller. So I think overall, the industry is fine. But there will be some probably.
You tweeted, then deleted a tweet suggesting perhaps liquidity issues at the likes of Coinbase as well as Grayscale. Is there reason to worry about that?
I don't think I tweeted about Grayscale, and also I didn't say there's liquidity issues at Coinbase. I was just referring to two articles. One article says Coinbase says Grayscale has 635K Bitcoins with them. The other article 4 months ago says Bitcoin only has 600K Bitcoins on the exchange. I understand the exchange is separate from the custody. So I just posted as a question, are those two numbers correct? But of course, that caused a lot of misunderstandings among communities, so I deleted the tweet.
Are there solvency issues to do with those companies? Some say that perhaps you tweeted because you wanted to build your own empire to spread the fear, the rumors.
Not so. Okay, so I don't know if there are issues with those other businesses. The thing with other businesses is unless we get very accurate financial statements, wallet addresses, we don't know for sure. But I'm not tweeting that because we want to build our empire. I think actually reflect on the FTX situation, and I kind of blame myself for tweeting that too late. We let, I think as an industry, we let FTX got too big before we started questioning some of those things. So I'm taking the approach where we ask questions much earlier. It does not mean any attacks on any of our industry peers. We just want to build more transparency and more scrutiny into the industry. Having said that, Coinbase has been operating for 10, 12 years. I think, they're listed company in the US. I'm sure they already have a lot of audited financials. Just we don't see that on the blockchain. For people in the industry, we like to see data on the blockchain, which is actually the most transparent way to display information.
CZ, you've talked about launching a crypto recovery fund. Where are you on that? You've talked about interest being quite substantial. Who's interested?
Yes, so we should have a blog article going out today. There's been back and forth on how to structure that. Do we make that a loose fund or do we make it an actual fund? I think we're kind of going with a loose approach where different industry players will just contribute as they wish. So I think a blog post is going out today. I think we're structuring so that it's going to be quite public. Whoever contributes move funds to a blockchain crypto address that people can look at. So it's not just some behind the scenes fund. So I think that's kind of being finalized now, and I think a blog post is going out soon.
That was the Binance CEO, CZ, talking exclusively to Bloomberg. Joining us now is Bloomberg crypto reporter Emily Nicole, who's been following the twists and turns of FTX and the role of Binance and this fund they're putting together. Good to speak to you once again, Emily. So let's start with FTX then. What is next for FTX, given we see daily headline after headline about the investigations, for example, that are going to happen to this business?
So there are several probes still ongoing by several different US agencies, and there's also the bankruptcy proceedings going on in Delaware. They arranged the hearing this week that they will move also some of the hearings that are going on about its bankruptcy proceedings in the Bahamas from New York to Delaware as well, so hopefully there'll be some kind of combining going on soon. But what we won't be seeing anytime soon is the names of the creditors who are involved in FTX, who have lost hundreds of millions left stuck in that exchange. The judge opted to keep those names private for the time being, which is quite an unusual thing to do. But hopefully, within time that might get reconsidered and we'll get to know a bit more.
Right, and why does that matter then? I mean, obviously for journalists, we like to know information. We like to know where the news might go next. Is that why? Because there could be contagion into other things that these people hold?
Yeah, the argument from FTX's defense and also from the judges that if by keeping these names private, they can keep those businesses a little bit more safe and secure in terms of contagion. They can stop other businesses potentially going after those companies who have funds locked in FTX to steal business from rivals. So that's the thinking there. But obviously, as time goes on, and as we heard CZ saying in his interview, transparency is what users are really pushing for. So. And
what did you make of CZ's assessment of where we've got to on all of this? He said the industry will be fine, but then he was also talking about how there will be further fallout to come.
This is kind of a rite of passage in crypto. Like we've had several bear markets now for this industry, and they are always very painful, much more painful than you might see in other sectors. And so it's very much likely that there will be more companies that are going to continue feeling the pain of this. We're expecting bankruptcy filings from several others to come out soon. Potentially, the names on that list that could file for bankruptcy are BlockFi, Genesis. Some of those are still engaged in last-ditch talks with investors to avoid that. But there's definitely a sense that there will be more companies that are experiencing liquidity crunches and will need that kind of rescue arm from Binance or other investors.
Yes, I mean, we talked last hour about how there seems to be a sense within the crypto industry that they need to police themselves, otherwise somebody else is going to come in and do that policing. I mean, why should they expect that they can sit outside the norms of the norms of society? I mean, other financial products require regulation, so why shouldn't crypto expect to be regulated just like everything else?
And arguably they can't, right? That is what regulators are saying. But at this point in time, it's been several years of crypto being an industry and several years without regulation, and we're now starting to see the real effects of that. We're having blow-ups on massive billion-dollar scales without any regulation in place. There aren't any regulators, for example, to protect investors in the collapse of FTX. There wasn't anybody around to protect investors in the collapse of Luna earlier this year. And so in this in-between time, I think the crypto industry is really trying to take it upon itself to say, well, if there aren't any regulators, we'll try and do what we can. However, though, that may also have its own effects. So
yes, I mean, today we shouldn't lose sight of the fact it is Thanksgiving, and a lot of families stateside gathering, and perhaps Americans around the world even gathering to be thankful. And this time last year, those who were big into crypto might have been singing its praises, telling their whole family about why they picked the right career and why crypto is the future of everything. This year might feel a little bit different. They might feel slightly under attack. I know you and others at Bloomberg have all been writing about the best defense in that situation if you come under that kind of attack from family members.
Yeah, I think the message that we've heard from people who are planning to have those kind of discussions around the dinner table is, well, these things have ups and downs. The stock market goes up the same way, probably not on the same scale, though. Yeah. But there is obviously a right to be concerned from family members as well for those who have put lots of money into these assets and lost big, because there are no methods of recourse in this industry, unlike that you might get if a company goes bankrupt and they're under several layers of insurance. In crypto, there's none of that. So there are going to be several conversations around dinner tables, I think, this year.
Okay, so could get into those exposures. Thanks very much for joining us. Really good to get your thoughts, Emily. Emily Nicole joining us there to take us through the latest twists and turns of the crypto FTX saga. We are going to take a short break here. Coming up on the Swedish rate decision later, the Riksbank Governor Stefan Ingves talks to the team. That's at 10 a.m. in New York, 3 p.m. in London. That's it for this hour of programming. European stocks up by 0.5%. Happy Thanksgiving, everyone. This is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. The problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? The why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome to Bloomberg Markets. I'm Tom McKenzie. Happy Thanksgiving. It is a holiday, of course, today over in the US with markets closed. Now, we are seeing European stocks gaining as investors keep an eye on global central banks. This hour, we will get the account from the last ECB Governing Council's meeting. Policymakers are having to keep an eye on the European energy crisis. Energy ministers holding an emergency meeting in Brussels. We're going to have a live report as crisis measures are put on hold, and the holiday shopping season is underway with Black Friday on deck. We discuss the retail rush to close the year. That is expected to show slower growth. Let's check in on these markets then. You saw the handover, of course, from the US, closing, of course, for that Thanksgiving holiday. But the S&P towards the end of the session yesterday marking its best gains up at the levels last seen about 2 months ago. So the handover to Asia, the MSCI Asia Pacific Index, the benchmark in that region, posted gains of 1.6%. Slightly different picture on the mainland in China, where you're seeing record COVID cases and a flurry of additional restrictions across cities, including the capital in Beijing. Here in Europe, you are seeing modest gains of about 0.5% on the European stocks 600. The FTSE 100 up about 0.2%, trading at 7,477. Slightly better picture over in Germany, gains of almost 1%. The DAX trading at 14,565. Of course, US markets are closed for that Thanksgiving holiday. Futures, though, looking to build on the gains of yesterday. Futures pointing up by 0.4%. We had the minutes from the FOMC yesterday suggesting there's no consensus around the terminal rate, but there is, it seems, a consensus from Federal Reserve officials around reducing the size of interest rate hikes from the central bank. The market's pricing in 50 basis points come that December meeting. And officials within the Fed as well suggesting there's now a 50% chance of a recession in the US. Let's check in on some of the other assets then. The pound in focus, 121, some strength then for sterling, gaining 0.6%, partly as a result of softer US dollar, but also possibly linked to comments that we're hearing from the Deputy Governor of the Bank of England, Dave Ramsden, saying that the BOE does have to continue raising rates regardless of the pain, simply because of the inflationary dynamics here in the UK. The 10-year, 2.9, so below 3% here in the UK. That's a 6 basis point move. There has been some move into gilts, but very much so into German bunds and Italian BTPs as well today. A bit of a catch-up from the session that we saw yesterday in terms of the move into US Treasuries. Brent trading at $85 a barrel. That's a drop of 0.5%. We continue, of course, to watch the discussions around the G7 oil price cap for Russian oil, and of course the gas negotiations, as painful as they seem to be over in Brussels. Bitcoin trading at 16,555, just a gain of 0.5%. We had an exclusive interview with the Binance CEO around setting up plans for $1 billion fund for that industry and sector. We will bring you that exclusive interview later in the hour. Joining us now, though, is Global Head of Investment Strategy for Europe, Morgane Deladon. Morgane, good morning, or good afternoon, I should say. Good morning, US time. Thank you for joining us. I want to start with what we're digesting from those Fed minutes, and the question as to whether or not there is a dual track kind of attempt here by the Fed to talk a hawkish rhetoric, as they at the same time plan to increase rates at a lower pace, at 50 basis points, for example, in December. Is that a dual track attempt by the Fed? How should investors be thinking about positioning around that?
Well, as you said, Tom, I think we are seeing the Fed really leaning toward downshifting the next Fed funds rate hikes to potentially 50 basis points. But what will be important for market is what it means for 2023, because market seems really keen to believe there will be a dovish pivot in the next year, especially in the light of the recent data coming out of the PMI earlier this week, lower than expected, but also inflation numbers last last month. So I think the difficulty for the Fed is that on one hand, there is some building pressure on the inflation side for the core measures, which needs to be addressed by keeping increasing interest rates. But at the same time, it's mitigating the negative impact on the economy and dealing with this increasing risk of recession. So overall, what markets could now anticipate is potentially further downshifting in the early months of next year, probably downshifting to potentially 25 basis points. But the Fed is also saying that they will be more comfortable with the real Fed funds rate in a positive territory, and it's still very negative. So the Fed could have some room to go, and the terminal Fed funds rate is probably mispriced at the moment at probably a lower level than what the Fed could go to. So it will be interesting next year to see how long the Fed will carry on with potentially lower hikes at the meetings.
Okay. Interesting. Let's stay with the terminal rate then. The dot plot's 4.6% is the dot plot, but of course Jay Powell says it's likely to be above that. That there isn't a consensus, it seems, from the Fed as to exactly where the terminal rate ends up. But the market's looking at 5%. Can they get to 5% if the Fed is now assuming there's a 50% chance of recession?
Well, I think what will be a game changer is the change of the pace for these rate hikes, because over the past four meetings, it's been 75 basis points, another potentially 50 basis points that are really large rate hikes. But if the Fed slows the pace of hiking, then maybe the economy will be able to support to stay resilient enough despite the increase of interest rates. But one thing we could expect is that the Fed will then pause at the top of its Fed funds rate for this cycle. So I don't expect the Fed to then directly start to reduce interest rates when they reach the peak. So that would be interesting. And the real dovish pivot, I think, will not happen before late 2023.
So do you have to wait? So that's interesting. You need to focus on the pace of rate hikes, and you think that pivot doesn't happen until late 2023. Does that mean you have to hold off in terms of ramping up your exposure to equities, or do you chase the rally that we see at this point?
No, I do think there is more rational for going back gradually to growth stocks. First of all, even if we can't really time when the Fed funds rate will reach the peak, we do see that the Fed is taking a more prudent approach. So that is positive for growth stocks. We are also seeing a lower US dollars versus its peers. So this is also encouraging for the profitability of these growth stocks. So I would say that we are really at a turning point where we seeing investors getting back to growth stocks, and also inflation numbers will be interesting to follow, and that will be also another driver of more coming back to growth stocks in the coming months, especially headline inflation, which is expected to decline quite sharply in the first half of 2023.
Okay, and you talked about the FX component, the dollar component. Has the dollar peaked? I'm looking at a 4% drop in the last 30 days on the Bloomberg Dollar Index.
Yes, the dollar index seems poised to continue to decline. First of all, because the Fed has started its tightening cycle earlier than other central banks, especially the ECB. So there will be some divergence there with the ECB continuing to hike. So therefore, the dollar might continue to decline to more normal levels, and that will boost profitability and probably sentiments towards upcoming earnings, despite some domestic weaknesses that we are starting to witness.
I want to get your views on China. There's a very confusing picture coming out of the world's second largest economy. We had a 20-point plan to try and move away from COVID-0, and now we're looking at record levels of infection in that country. Of course, comparative to the US and other nations during the height of the pandemic, nowhere near the numbers. But nonetheless, it's a complicated situation, restrictions, lockdowns in many cities, including the capital, of Beijing. Do you want further exposure to China? They're going to have to come out of this at some point, whether it's early 2023 or till the end of 2023. When do you want to start to position for that in China?
Well, I think there will be no coming back from the steps taken towards easing the COVID-0 policy. I just think that we can expect a stop-and-go type of approach driven by the new waves of COVID cases. So that may drive some volatility, but at the same time, when you look at valuations, they are very attractive. The risk on the geopolitical side seems reduced, especially since the dialogue that restarted between President Xi and President Biden. And also, when you look at the forecast for growth next year, the differential between growth in EM versus DM is also favoring more exposure to China and to broader EM countries. So I do think that there are some more rational to get into Chinese equities, but at the same time, the investors seems really polarized on their expectations for China.
Polarized expectations on China. We're also hearing that there may be some more fiscal stimulus coming down the pipe as well in terms of cuts to reserve ratios for the banks there. Just briefly, before we let you go, Morgane, what is the fixed income trade of choice?
Really hard to say right now, but I do think that caution is still important. And when you look at real yields, especially across the U.S. Treasury curves, you can see that there are positives now across the whole yield curve, around 1.5%. So with all these yields coming back positive on real rates, I think there is a case for being more prudent on the fixed income side and probably go to sovereigns and probably investment grade bonds in the developed world.
Sovereigns, investment grade in the developed world, maybe some opportunities in China, a polarized view, of course, on that economy. Morgane Deladon, excellent insights. Thank you. Global ex-head of investment strategy for Europe. We appreciate it. Right, keeping you up to date with news from around the world. Here is the First Word News on Bloomberg with Laura Wright. Laura.
Thanks, Tom. In Ukraine, a barrage of Russian missiles has knocked out power for millions. The attack came at a time when temperatures are below freezing. In a virtual appearance before the UN Security Council, Ukraine's President Volodymyr Zelensky called the missile assault a clear crime against humanity. Meanwhile, the Biden administration is sending Ukraine another $400 million worth of military aid. The package includes air defense missiles and artillery rocket systems. Weapons are being taken from existing Pentagon stockpiles. In the UK, Chancellor of the Exchequer Jeremy Hunt wants the Treasury to assess the benefits of taxing wealthy foreigners with so-called non-dom status that allows British residents whose permanent home or domicile is outside the country to avoid paying UK taxes on overseas earnings. Hunt says he wants to make sure that any move to tax non-doms doesn't lead them to leave the UK. A big donation to charity from Warren Buffett. The billionaire has given Berkshire Hathaway stock valued at $758 million to a number of charities, including one named after his late wife. In 2010, Buffett started the Giving Pledge, saying he would give away 99% of his fortune. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Tom.
Laura, thank you. Coming up, the retail rush hits not just in the US, but also here in the UK. We're going to dig into the expectations for Black Friday, those changes around the consumer, different retail themes, how it's all playing out in stores and online. Stay with us for the analysis. This is Bloomberg.
the standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Digital Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome to Bloomberg Markets. I'm Tom McKenzie. Now, as fans focus on the World Cup, another big sports story centres around the Glazer family, the owners of Manchester United, as they are exploring strategic options that could lead to a full sale of the storied club. Earlier today, we caught up with former Goldman Sachs economist Jim O'Neill, who once bid for Man U.
I'm a pretty passionate person at this era of Britain's evolution and democracy and capitalism's evolution, what I would say with profit with purpose and not profit with no purpose. And I think whoever tries to satisfy the price that the Rain guys in New York that the Glazers have hired to sell it, they need to think carefully about what it is like becoming an owner of Manchester United. And I think with that as the number one factor, the second one is I can't really see the external environment and the specific environment around the commercial business of football being the same the next 20 years of what it's been the last 20 years. So that suggests to me that a lot of smart, rational people are not going to go chasing after buying Manchester United, despite the facts. It is quite easily the biggest sports brand in the world.
Okay, do you think prospective U.S. buyers will be put off by how much Man United fans hated the current owners?
I'd answer you slightly differently. I would say to prospective U.S. buyers, or for that matter, any buyers, if you don't engage the fans and treat them as partners and part of the wonderful thing that is Manchester United, then you're going to have a pretty miserable time owning them.
Okay, do you think, I mean, what happens then longer term? Do you think they will be able to sell? And I don't know whether if it goes for 3-4 billion, you could still lead a consortium. We know a number of people that maybe, you know, bid for Chelsea that could be interested in this club.
I mean, my honest answer is I've no idea. To me right now, it seems completely out of reach of normal human beings, or for that matter, not so normal, very successful business human beings. And I wouldn't want to myself lend my name to people that were just trying to indulge the merry-go-round that it in some ways appears to have become.
Okay, that was former Goldman Sachs economist Jim O'Neill, who was part of a consortium back in 2012 that attempted to make a play for Man U when it was up for sale then. Talking of which, there's also speculation that David Beckham may be involved, or at least has been tapped on the shoulder, has been reached out to try and get his endorsement from some looking at a potential buy of Manchester United. It's a continuing story for us, of course. When it comes to the World Cup, just to update you on the score, Switzerland, by the way, beating Cameroon 1-0. A really big match later today is going to be Portugal versus Ghana. You also have Brazil versus Serbia, so two big beasts playing later today. Portugal, we're going to go, of course, looking for Ronaldo following his pretty surprise shock departure from Manchester United, given that pretty implosive, devastating interview that he gave, but also watching Brazil as well versus Serbia. Now, with the holiday season upon us, Black Friday could be more important for UK retailers this year as they try to encourage shoppers to spend cash now before the cost of living crisis erodes their Christmas budgets. Marshall Cohen is the Chief Industry Advisor for Retail at the NPD Group, and he joins us now. Marshall, we don't want to just get your views on what's happening in the UK, but also, of course, in the most important market when it comes to the consumer, which is the US. What are the themes? What are you seeing in terms of consumer habits that are different this year versus last year? Post-pandemic, with the cost of living crisis, inflation concerns, what is emerging in terms of consumer habits?
Well, the biggest change this year is the stores are playing a much more important role. Online is sliding back a little bit. It's kind of level set over the past 12 months. Brands direct have done well, but overall, pure plays and online components of retailers that have store presence, the store's part of the equation, much more important as socialization kicks back in. This is an interesting year because we saw the early start to holiday, but it actually started slower. So we've slid back to previous year levels in dollar sales in the US. We've slid back to 2019 levels. So that's an interesting challenge right there. When you think about what's happening, we've had weather play a key role, much warmer. We didn't get the seasonal shift. Earlier promotions certainly have eroded the power of the promotion and the impact that we've had leading up to Black Friday. COVID purchases, all those products that we bought during the COVID lifestyle certainly have had an impact, particularly in things like tech and even toys. And then the lack of newness. I would say that's probably the biggest story out there, is just the lack of confidence and lack of innovation in the marketplace. What do you really need that you haven't already bought over the past year or two? So this is an important component. And then here in the States, we had an election distraction. This was more like a major election, a presidential election. So we had a pullback over the past 2 weeks.
So are you seeing, Marshall, as you know, we've seen that retail data out of the US holding up stronger than somebody expected. Are consumers, are they trading down? Are they buying less? Are they doing a bit of both?
So we're seeing dollar sales holding on, but a lot of that is inflation. Unit sales are actually sliding back a little bit, and that's the piece that we're working. So consumers, the demand for product has been actually less than what we've seen in the prior 2 years. But when you're selling products at higher prices, and remember, keep in mind the inflationary price, it's going to cost more to put a meal on the Thanksgiving table this year by between 15 and 18% more. So those that are hosting the meal, well, they're going to have less money to spend on gifts. Kids will have a good holiday. I'm not concerned about kids getting their Christmas gifts, but it is going to be a challenge for retailers to really be aggressive when it comes to inventory management, promotions, and enticing the consumer as they just keep waiting.
Yeah, 20% on your Thanksgiving dinner. That's not something you're going to welcome, is it? In terms of the discounting, how is that changing? Are retailers, are they under pressure to shift inventory, or are they under pressure to maintain margins and reduce the discounts?
That's a very important question. And we've seen so far, more frequent promotions, but not deeper discounting. But that will very likely change as we get closer to the holiday because of the inventory concerns. They do not want to carry excess inventory going into 23. And 22 will be more about volume. 23 is going to be more about margin.
Okay, Marshall Cohen from the NPD Group, thank you for that analysis as it leads up to Black Friday. The discounting certainly already started here in the UK. Markets across Europe, you're seeing gains of 0.5%. US equities, of course, stocks closed, bonds as well, of course, for the Thanksgiving holiday, but futures pointing up on the S&P E-minis by around 0.2%. The Bloomberg Dollar Index as well, down again, 0.2%, so giving a bit of support for the single currency euro, currently trading at 104, the pound at 121. That's a jump of 0.6%. Still ahead, we are live to Brussels, where EU ministers are gathered to try and find common ground on the growing energy crisis. We will bring you that story. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Welcome back to Bloomberg Markets. Happy Thursday, happy Thanksgiving. I'm Tom Mackenzie checking in on your markets for you. Then the European benchmark currently posting gains of just close to 0.5%. Every single sector in the green, led by real estate. At the bottom of the list, energy, still clinging on to gains though, that sector. When it comes to the future stateside, when those markets do reopen after the Thanksgiving holiday, you're looking at gains of 0.3%, according to the futures S&P. E-minis just above 4,000 in the S&P at the highest level in 2 months. That's where it closed yesterday. There is a move as well into German debt, into Italian debt, into UK gilts as well. I'm focused on the 10-year over in Germany. 182, there you go, on the 10-year, the benchmark over in Germany. That is a 11 basis point move lower in terms of yield. So money moving into German debt quite aggressively. 121 on the pound, 121. That's a gain of 0.5%, partly on the back of comments from the Deputy Governor of the BOE, but also, of course, dollar softness, and that does continue that trend. 121 on sterling. That's the best level you've seen since at least August the 17th for the British pound. Now, we are going to continue to focus on what's happening in the ECB as well. We're expecting some updates. We also heard from the Dutch central bank governor on the board, of course, of the ECB, saying he expects to see inflation remaining elevated next year and in 2024. Further rate hikes then is the view from Klaas Knot. For more, let's bring in Raffaella Tenconi, ADA Economics founder and managing director, and Wood & Co. Chief Economist. Raffaella, thank you for joining us. I want to start with the view then that the markets are not yet pricing in enough from the ECB. Are they behind the curve, the markets, on this, or are they getting ahead of their skis? Klaas Knot, we know, is a hawk, but he's saying he sees inflation remaining elevated through 2023.
Hi, good afternoon. It's a pleasure to be with you. Well, look, the inflation outlook, the good news is that we're very close to the peak, even in Europe. The bad news is that you're probably realistically looking at best at Eurozone inflation converging to maybe 4% on average in 2024. So it's still very far away from where the ECB wants it. We now see a lot of hawkish comments in the council. So in terms of interest rates, we could be going to 2.5%, maybe 3%. But a lot of the action is really going to happen in the bond market. I mean, we think that on the basis of this inflation assessment that we have, core Eurozone bond yields, you mentioned the bonds just a minute ago, the 10-year should really be trading at 3.5%. And I'm not even being too aggressive given the inflation outlook. So there is something that is fundamentally mispriced. It appears to me it's more going to affect the bond market than actually the front end, so the refi rate. But definitely the market is being too excited by the US news lately, and it's assuming that Europe will do exactly what the Fed is about to do.
181 on the German 10-year. There's a long way to go to get plus 3% on German bonds. What would need to happen in terms of the level of rate hikes? So you see plus 2% from the ECB. I mean, that's a remarkable shift that would need to happen to get bonds to those levels.
Yeah, I think, well, first of all, quantitative tightening is going to happen. So the market has to process that. The second issue is that although we do expect a recession, and definitely you do see all of the signs of GDP contracting in the Eurozone, it's not going to be a massive recession. And in the background, you still have the digitalization, the reshoring, the energy transition. These things put a lot of strain on the labor market everywhere, especially in Europe. So we think that you're not going to see very much unemployment actually in the near term. And in a market like Europe, where there is a lot of contractual rigidity, actually all of the wage pressure is still ahead for many core Eurozones. So the ECB will also have to face a labor market is a lot more resilient than what they would want it to be. So I think that definitely is going to contribute.
Are you starting to see evidence of a cost price spiral in Europe as a result of that latent pressure on wages?
Well, as I said, the good news is that we are close to the peak of the inflation rate. So the bulk of businesses' pricing intention has got less aggressive than what it was in the last 24 months, but it's still exceptionally high in historical terms. And there is a lot of pent-up costs that has not been passed on to consumers. So look, the good news is that Europe is trying to smooth the energy cost, the energy shock, otherwise it would be a much deeper recession. But of course, the other side of that is that consumers can borrow to continue to fund purchases, and that allows businesses to, eventually pass on the costs.
We're currently getting some lines from the ECB, Raffaella, so I'll just bring those to your attention, our viewers' attention as well. The ECB, a very large, this is the account from the most recent meeting, a very large majority of officials backed 75 basis point hike. You're also getting a line from this account from the ECB. Schnabel, of course, one of the officials, one of the members on the board, warned that a weak euro may cause price pressure. Talking of which, the euro currently trading at 104, just to move higher by about 0.1%. There's softer dollar as well, playing into that, of course. Does the euro remain above parity within this environment, Raffaella? How consequential is that to the inflation dynamics?
I think it does, as long as the ECB is willing in one way or another to continue to fight the inflation path. Because, as I said, I mean, inflation is converging towards 4% on average 2024 if they deliver rate hikes and bond yields normalization. I mean, otherwise, actually, the dollar strength will resume because you're talking about massive negative real interest rates. And the other thing that I want to point your attention to is that although we forecast a slowdown of GDP, house price inflation remains positive through the whole forecast horizon. So you also don't get any relief from housing inflation or rents inflation. And this is a very big factor in pricing for most businesses.
House price inflation remains elevated. Really interesting point there as we look at countries like the UK, Canada, the US, where house prices are coming off. Just before we let you go, just remind us of your growth forecast and how you've adjusted that as you look towards the end of 2023, Raffaella.
For 2023, we think Eurozone will contract by about 1.2%. So it's a meaningful but not aggressive recession.
Okay, meaningful but not aggressive recession. We'll see how the data plays out. We had the IFO Institute survey coming out earlier today suggesting that confidence is coming back, at least on the margins, in Germany as well. Raffaella Tenconi, ADA Economics founder and managing director, and Wood & Co chief economist. Thank you very much indeed. A redhead crossing the terminal. Just bring the details for you now. Saudi Aramco's base oil company has been given approval for an IPO. Of course, Saudi Aramco, in terms of listed companies, one of the biggest listed companies in the world. Just bring details around this base company. So it's pushing ahead with plans for an IPO of its energy trading business, which itself would rank as one of the largest share sales this year. That is according to people familiar with the matter. Likely to list in Riyadh as early as this year. It is also Aramco in discussions to hire more advisors for the IPO. So that's a redhead crossing the terminal. Saudi Aramco said to push ahead with its IPO for its trading unit. We'll bring you more details if and when we get them. Now, sticking with energy, the European Union is set to pause efforts to approve a package of emergency measures to curb fallout from high natural gas prices as diplomats try to resolve a deep split over a push to cap the cost of gas. We are now joined from Brussels by Bloomberg's Europe correspondent, Maria Tadeo. Maria, you talked to us earlier in the morning here in Europe about the painful nature of these discussions. What has emerged since then?
Well, Tom, it's a no breakthrough. And if I had to describe what happened this morning, I'd say energy ministers have not rejected the Commission's energy package, but they've not fully endorsed it either. So that means this thing is now on hold. Now, the sticking point, we know it very well. It has been very well documented. Some of the language this morning, which referred to specifically the price cap as a joke, badly designed, a mockery. Of course, they referred to that threshold of 275 euros for 2 weeks in order for that price cap to be triggered. On the opposite side of the spectrum, the Dutch energy minister told me that by definition, we're now seeing, as this debate drags on, that this is a flawed concept and potentially a bad idea that could disrupt supply. So ultimately, we're in a situation where in Brussels, nothing is agreed until everything is agreed. So they've now decided to reconvene on December 13th. Now, the timing, Tom, if I may, it's also interesting because this will happen 2 days before the European Central Bank meets and 3 days before European leaders gather here in Brussels for their final meeting of the year. So I'm not sure about you, but I know exactly where I'll be those 3 dates, and it's probably right here on the spot.
You're going to have a very busy mid-December, Maria. No break for you. When it comes to the G7, though, and the price cap around Russian oil, is there more progress there?
Well, Tom, the reality is we don't know because the meeting has not really started. This is European time. Of course, I also want to see the U.S. awake and operational, so we're expecting a decision to come late into Brussels time, but the tone around it is different to the gas, and we should make a difference also and point out that we're talking about oil in this case, capped at around $65 a barrel, potentially 70. The price point continues to be a sticking point here. A number of countries, particularly the Poles and the Baltics, suggesting at 65 that is still too generous for Moscow. Also big questions as to whether or not this is going to make any difference for Russia on the bigger picture and the war in Ukraine. But we are being told that a deal is within reach and potentially coming today.
There has been progress across Europe, particularly in Germany, where demand has come off. They've faced up to the reality of reduced flows of Russian gas. Is there a risk, whether it's gas or oil, that with these price caps put in place, if indeed they are put in place, that the demand doesn't match the reality in terms of the flows and the supply in the years ahead?
Tom, that is really the question, and that's why some have fears, particularly, we should note this, for the European Union, gas is a much bigger story than oil at this point. This season, we know the storage season is now fully booked, but of course, there's big questions in terms of what do we do for 2023 and 2024. That will be the real point. And there are fears, again, going back to your question, that if you start to change prices artificially in a market that is so tight and so fierce, you will have supply issues. Now, the other point, Tom, that is worth mentioning here is that if you're not competitive on the price point, then you have to be competitive on duration. That means you lock in long-term contracts, 10 years, 15 years, 20 years potentially. But as you know very well, that's also problematic for the European Union because it could clash with some of the deadlines of the Green Deal. So, of course, it's a very difficult one to square.
Yeah, so the Chinese walk away with those long-term deals from the Qataris, and the Europeans wring their hands and say, we want the short-term contracts, not the long-term contracts. That is a challenge as well. Maria today, always excellent on the ground for us, of course, following what are pain talks and discussions around the gas cap. Of course, G7, a little more progress, it seems, a little bit more light at the end of the tunnel on that front. Important to distinguish the two within this energy complex. Talking of which, Brent currently trading at $84 a barrel. That's a drop of 0.7%. WTI at $77 a barrel. Look at that, down 0.3%, well below that $80 level. Of course, the discussions around G7, the cap, the potential cap on Russian oil is playing into that. A slightly higher level than maybe some had thought previously. So we continue to watch what's happening in the oil space. Across your equities, the benchmark here in Europe up 0.5%, holding on to these gains. Again, every single sector bar one in the green right now. Real estate leading up 2%. Coming up, Binance offering crypto markets a bailout. Yes, the CEO, CZ, spoke exclusively to Bloomberg, outlining a $1 billion plan to backstop the industry. We bring you that exclusive conversation. That is up next. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa. African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, of the US, Europe and the UK, have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
When you think space, you probably think one space agency that travels under the radar is ESA. Which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Welcome back. You're watching Bloomberg Markets. I'm Tom Mackenzie in London. Now, the fallout from FTX continues to roil the crypto markets, with crypto billionaire CZ further outlining his plans to backstop the stricken industry. Earlier, in an exclusive interview, he spoke to Bloomberg's Haslinder Armin about the knock-on effects from the FTX collapse.
We'll see a little bit of contagion. Whenever one big player goes down, especially a trading platform, there are many other people or institutions with money on the platform. I think we've seen Genesis halting withdrawals. I think there probably may be one or two more, a couple others. I don't know how many. But each time there's cascading effects, the effects become smaller. So I think overall, the industry is fine. But there will be some probably.
You tweeted, then deleted a tweet suggesting perhaps liquidity issues at the likes of Coinbase as well as Grayscale. Is there reason to worry about that?
I don't think I tweeted about Grayscale, and also I didn't say there's liquidity issues at Coinbase. I was just referring to two articles. One article says Coinbase says Grayscale has 635K Bitcoins with them. The other article 4 months ago says Bitcoin only has 600K Bitcoins on the exchange. I understand the exchange is separate from the custody. So I just posted as a question, are those two numbers correct? But of course, that caused a lot of misunderstandings among communities, so I deleted the tweet.
Are there solvency issues to do with those companies? Some say that perhaps you tweeted because you wanted to build your own empire to spread the fear, the rumors.
Not so. Okay, so I don't know if there are issues with those other businesses. The thing with other businesses is unless we get very accurate financial statements, wallet addresses, we don't know for sure. But I'm not tweeting that because we want to build our empire. I think I actually reflect on the FTX situation, and I kind of blame myself for tweeting that too late. we let, I think as an industry, we let FTX got too big before we started questioning some of those things. So I'm taking the approach where we ask questions much earlier. It does not mean any attacks on any of our industry peers. We just want to build more transparency and more scrutiny into the industry. Having said that, Coinbase has been operating for 10, 12 years. I think, they're listed company in the US. I'm sure they already have a lot of audited financials. Just we don't see that on the blockchain. For people in the industry, we like to see data on the blockchain, which is actually the most transparent way to display information.
CZ, you've talked about launching a crypto recovery fund. Where are you on that? You've talked about interest being quite substantial. Who's interested?
Yes, so we should have a blog article going out today. There's been back and forth on how to structure that. Do we make it a loose fund or do we make it an actual fund? I think we're kind of going with a loose approach where different industry players will just contribute as they wish. So I think a blog post is going out today. I think we're structuring so that it's going to be quite public. Whoever contributes move funds to a blockchain crypto address that people can look at. So it's not just some behind the scenes fund. So I think that's kind of being finalized now, and I think a blog post is going out soon.
And that was Binance CEO Changpeng Zhao, who is also known as CZ, speaking exclusively to Bloomberg earlier, the crypto billionaire outlining his plan to backstop the industry after, of course, the FTX blowout rattled markets. Join us now for more on the context, the analysis is Bloomberg's senior editor for crypto, Ana Herrera. Ana, in terms of the fund that he was talking about there to Haslinda, $1 billion, is it consequential? Do we know where the money's coming from? How much of a plaster will it be on this crypto market? It is so badly wounded at this point.
We don't know yet where the money's coming from. We should get a blog post today, he said, that will explain it. Obviously, it might have been better if the money was coming from outside. He mentioned that it's coming from they've been talking to other industry players. So, it would have been a great vote of confidence if we said someone from outside crypto put more money in, but we'll have to see. I guess it's better than nothing, right?
I said plaster. I should translate that for our American, the Band-Aid on the crypto market. When it comes to the next victim, the potential next victims of this fallout, he flagged that he thinks more dominoes are going to tumble. Where you and the team focused your sights right now? Where is the vulnerability?
We've been reporting on Genesis, which is a brokerage. They are raising money and have told investors that if they don't raise money, they might face bankruptcy. And obviously, they're another key player. They're a lender. They also have a brokerage. And so, they're everybody's counterparties. If something goes wrong, then, it might affect another company and another company. So CZ said that, it will have a little bit of, they'll cause a little bit of pain, but not too much. So but we'll have to see, because this has been going on for like a bit now, right? Companies falling.
Yeah. And Genesis is linked to the Winklevoss twins, Gemini, their platform as well. How much distinction should we make between the Binances of the world that are not resident and located in the US versus the Coinbases of the Geminis? Is there greater safety around those platforms because of where they're based, because of the jurisdictions, because of the SEC, the regulatory environment?
I guess they have more supervision, but there have been failures there too. We have seen FTX was based in the Bahamas, and so I guess one of the arguments could be, there are platforms offshore, and they might, make customers less safe because there's less people supervising them. But Celsius had a base in the U.S., I believe. So,
are regulators behind the curve? What do we know? What are the machinations happening in the halls of power, whether that's in DC or Brussels, around how to put some red lines around this industry?
It's been discussions that have been going on for a long time, right? Crypto, you need to be careful, and every time there are warnings after exchanges collapse. I think now maybe regulators have become a bit more aggressive. We've seen in Singapore they've become definitely a little bit more strict and have proposed some new rules. In the US, they're still arguing, is it a security, is it a commodity? And that's, I think, slowed down a bit progress. But definitely, like, if more people, normal people, get hurt, then perhaps there'll be more of a push from regulators or policymakers.
Okay, the proponents, of course, of crypto say that, look, the fundamentals are still there. The institutional buyers haven't all radically pulled out. They're obviously very cautious at this point. You hold your coins in a cold wallet. There is still a fundamental play here, particularly around the blockchain and the blockchain technology. Does that argument, does it still hold up? How much is that being challenged?
I guess, I would separate the asset from the technology, but for the asset, it's still not crashed completely, right? Obviously, it's crashed from a year ago if we look at the price, but it's still holding up a bit compared to the magnitude of what happened. A crypto proponent would say this is the perfect example of why you need crypto. You don't want centralized exchanges like FTX. They're actually just a traditional model. But obviously, for a normal investor, they might not be able to distinguish between what a crypto idealist thinks and the platform that they use to buy.
Okay, because you do hear from some, and CZ was talking about Web3 and DeFi and how that is going to be the next stage, and underscoring that is exactly why you want decentralized finance, so we can all have some greater stake in how we control our money. That is still a play from these crypto enthusiasts. Just briefly, the validity to that kind of view and that kind of stance.
I guess we have to see what adoption will be like after that. We've seen a little bit of shift from centralized exchanges to decentralized one, but of course, if something happens there were hacks on decentralized exchanges, then you have no recourse, because who do you go and complain to? So there's so much that needs to be sort of figured out.
It's the lack of recourse is also a challenge. Ana Herrera, of course, from our Bitcoin team, a senior editor looking at the space. Worth noting that Bitcoin is currently down, currently up 0.3%, 16,524. Ether up more than 2%. Coming up, we're going to have plenty more. Stay with us. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to Bloomberg Markets. Happy Thanksgiving. I'm Tom Mackenzie in London. Now, it is, of course, a holiday today in the US with markets closed. Policymakers and investors, though, are keeping an eye on what is happening here in Europe, the European energy crisis. Energy ministers holding an emergency meeting in Brussels. We will have a live report as crisis measures are put on hold. Plus, Bill Ackman's big short on Hong Kong and the Hong Kong dollar. He reveals that he is betting big on a collapse of Hong Kong's pegged dollar. We're going to dig into the details and find out whether he's on the wrong side of that bet. And China, COVID cases hitting a record high as tighter restrictions and more lockdowns stoke social unrest. Let's check in on these markets then and recapping what is happening and what happened in the Asian session. Broadly, it was a positive picture in Asia. The MSCI Asia Pacific actually notched up gains of more than 1%, but over in mainland China, you did see losses very much linked to what is happening on the COVID front. Further restrictions, particularly in the capital of Beijing, record high cases now in terms of infections around COVID in the world's second largest economy. Here in Europe, you're seeing gains of 0.4% as investors continue to digest those FOMC minutes. Broadly, you are looking at something of consensus in terms of moderating the rate of hikes, at least the scale and size of those hikes. Markets pricing in 50 basis points for the December meeting. Not a lot of consensus, it seems, in terms of the terminal rate. Fed officials as well, staff there suggesting there's now a 50% chance of a recession in the US. US futures, though, they held above those gains you saw, above 4,000 at the close yesterday. Futures pointing to build on that further by around 0.2% as things stand. Volatility as well, this isn't played, it's come off quite significantly in the last few days. So we're just watching that for you. The VIX currently just below 21 at 2048. And again, tying into modest risk-on sentiment within these markets. Here's a look at the currency markets. There's been a bid for the pound, 121 on sterling. That's at the highest level since at least mid-August. So getting back some of the gains after the losses you saw in the disastrous mini-budget from the former Prime Minister Liz Truss. Gains of 0.5% in the session today. UK gilts as well, bid at the long end at 296, below that 3% level. That is a move lower by 5 basis points. Brent is in focus for us, as is WTI. $84 a barrel on Brent, that's down 0.6%. The Europeans, others looking at the G7 and that potential price cap on Russian oil. And Bitcoin in focus as well, 16,500. Yes, a little very modest gain, 0.4%. We had that exclusive interview with the head of the world's biggest crypto exchange, Binance, on his attempts to shore up that industry. Joining us now is Wells Fargo Investment Institute head of global markets, Paul Christopher. Paul, thank you for joining us. Happy Thanksgiving. Let's start with the FOMC then. You are saying that arguably the terminal rate, the expectations for a terminal rate above 5%, a handle of above 5% is maybe looking a little overambitious at this point. Why will we not get there?
Yeah, it might be that the Fed's taper doesn't quite get us to 5%. Our view is that maybe it lands a little bit short of there, but the real point here is that the market exuberance, I'll call it, over the tapering itself is a little bit misplaced and premature. You're still going to have Fed rate hikes in place for a long time into 2023, and we have earnings expectations already coming down. The economy is starting to show signs of contraction.
Where are you seeing the weakness, Paul? We saw the retail sales numbers coming through pretty strong. Yes, you've seen softness around the mortgage market, or at least the housing market. Mortgage rates have come down. Where is the vulnerability within this US economy as those Fed officials and staff suggest that now the odds are 50% of a recession?
So you named it right there. I mean, housing is such an important driver here in the US of the economy. And we think that as incomes continue to see inflation outpace them, that especially the bottom 3/5 of the income distribution are going to find it increasingly difficult to spend. That's going to hit retailers. We're going to see retail sales eventually getting hit. And you're starting to see the beginning of layoffs, too. So that's a precursor of things to come. Remember, the employment picture is the last pillar to fall, but cracks are already evident there.
The employment picture is the last pillar to fall. Really interesting. And as we look at the tech sector, clearly very high-profile layoffs, whether it's Stripe or Twitter or Meta. But you're saying that those layoffs are now spreading to other sectors. Where are we starting to see that?
You're starting to see, you're starting to see growth in jobs slow quite a bit, hours slowing, wage growth slowing. The increases in layoffs I wouldn't necessarily attribute to the slowdown so much as what you're seeing in tech, for example, is related to that sector and multiples that are still too high there, prospects for growth that are being ratcheted downward. But the labor market as a whole is starting to look to us slower, softer, and in the preliminary stages of what we think will eventually be, again, that last pillar to fall.
What is the valuation picture looking like for you within that context, Paul? Is there a further squeeze on valuations as we look into 2023?
Still a little bit too high on valuations, mainly we think because the earnings are still too high. Fourth quarter, we're finally starting to see firms acknowledge that fourth quarter is going to be a down quarter. And we think that continues into 2023. I mean, again, the point is not how many more times the Fed raises rates, but the fact that inflation remains high and the Fed has raised from near zero to what will eventually be something close to 5%. And don't forget quantitative tightening. That's what allows all those retail sales that you were mentioning to continue. But as the liquidity comes out of the economy, it's going to be increasingly difficult to skate by the weakness in other sectors.
So where is the margin resilience?
Well, the resilience right now is in liquidity. It's in those top two income quintiles. That's where most of the demand deposits are. That's where most of the liquidity is. But it's really been almost a year now for those high net worth investors who've been taking or who were able to take money out of the stock market over the last year or so. They've not been able to do so without facing losses. So they're living on sort of the residuals, let's call it, of the market gains of the last 3 years. And those are going to be running out. And as they do, we think we'll start to see retail sales come in line with other weak points in the economy, such as housing that we're seeing.
Okay, and if you think that valuations are still looking a little too rich, you know, we hear from strategists who come onto the show and they say, well, the US is looking a little overvalued. Maybe there's opportunities in Europe, in EM, where valuations are looking more attractive. Do you align with that view, or are you concerned about the vulnerabilities within those jurisdictions as well?
Yeah, concerned about the vulnerabilities. Cheap can always get cheaper. And we don't think a bottom is in yet, certainly not in Europe. It's far too early to call an end to the energy crisis. If you lift emergency measures, it just means that maybe you were a little bit too early in implementing them. The real test comes in December into January when it gets the coldest in Europe. We'll have to see there. And again, it's going to be difficult for those large European companies to do well if China is still slow and sluggish under COVID restrictions, and if global trade more generally is weak, as we forecast that it will be heading into 2023. So we would hold off on Europe right now. We would hold off on emerging markets. We think it's a little premature in both of those regions.
And you touched on China, and again, the headlines today, record cases in terms of COVID measures. More importantly, the restrictions remain, despite attempts by officials there to soften and get out of COVID zero. They seem like they're a long way from that. What do you need to see? What are the signals? What are the data points? What is the stimulus, the support that you need to see from officials in Beijing to start to reallocate to China?
Yeah, they've been tweaking those restrictions, but mainly around the edges. You still have winter coming. It doesn't make sense to us that they would remove those restrictions in any material way at this point. With the cold weather coming, you saw that the cases were at a record high, and Beijing is in lockdown territory. So we don't think that that's going to be a policy that changes very much. We need to see more than just tweaks. We need to see lifting of the restrictions. We think that's probably not until next spring, or perhaps even a little bit later.
And Paul, I know you're conservative on equities at this point. You don't think it's the time to broadly buy these markets, but you do favour within equities, IT, healthcare and energy. Give us the rationale around energy. Of course, one of the outperformers when it comes to the sectors year to date. How does energy continue to thrive in a recessionary world?
Yeah, it's you have to sort of look through this recession a little bit, but energy has been a sector that's generated cash throughout the year. It's one of the few sectors that have done so in the S&P 500. We like that ability to generate cash, and we do think that the world, even as we move through this recession over the next few months, that the world will still be short enough of energy that we like our target of $100 to $120 a barrel on West Texas Intermediate by the end of next year. So we would treat this period of weakness as something as a buying opportunity, and looking ahead several months to a point where crude oil begins to gain traction. And we think energy is a good place to be.
What do you like in fixed income? Where do you want to be on the curve? What maturities are you looking at, Paul?
Yeah, it's sort of a barbell approach right now. Again, we're waiting for an opportunity in equities, and we're showing that we're waiting to take those opportunities when they appear by doing so in fixed income. And on the fixed income side, we like the longer term, the 10 years, and we like the shorter term, something really short that gives investors who need cash or need to put cash in a particular place where it doesn't lose any money. Those investors, and then the longer term ones who want to take advantage of yields while they're still high, we want to give them a chance to take advantage of both of those opportunities. We think that the peak in yields is not far off, and that therefore 10 years and longer is probably a good place to start dollar cost averaging in. But until we really see inflation and the Fed come down and the recession really get underway, we think it's still probably a pretty good bet to put some money into short term. Over the next few months, you may have an opportunity to see that money mature and then have the option to reinvest it or go into equities.
Paul Christopher, Wells Fargo Investment Institute Head of Global Markets. Really fantastic insights. Thank you for joining us this Thanksgiving. Happy Thanksgiving to you and yours. Right, keeping you up to date with news from around the world. Here is the First Word News with Laura Wright. Laura.
Thanks, Tom. In Ukraine, a barrage of Russian missiles has knocked out power for millions. The attack came at a time when temperatures are below freezing. In a virtual appearance before the UN Security Council, Ukraine's President Volodymyr Zelensky called the missile assault a clear crime against humanity. Meanwhile, the Biden administration is sending Ukraine another $400 million worth of military aid. The package includes air defense missiles and artillery rocket systems. Weapons are being taken from existing Pentagon stockpiles. In the UK, Transport Secretary Mark Harper will meet with Labour leaders in the coming days to try to defuse the threats of further rail strikes. The Rail Workers Union has set out 8 more days of stoppages in the run-up to Christmas and in the new year. Unions are demanding pay hikes that keep pace with inflation. In Alaska, Democratic Congresswoman Mary Peltola has won re-election in a rematch against conservative icon Sarah Palin. Peltola has served as the state's only representative in the House since September. She will serve a full 2-year term starting in January. Palin was the Republican candidate for vice president in 2008. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Tom.
Laura Wright, thank you very much indeed. Just a redhead crossing the terminal right now. We're talking about central banks, of course, following those FOMC minutes. South Africa raising its benchmark rate by 75 basis points to 7%. That was in line with estimates. We also got some lines from the ECB Schnabel speaking here in London, saying that the data suggests there's limited room to slow the pace of hikes from the European Central Bank. Rates probably need to reach restrictive levels. We are not close to that yet from the ECB. Coming up, we will look ahead to US-China relations, coming off of the meeting, of course, between Biden and Xi at the G20, but also between their defense ministers. Geopolitical strategist Tina Fordham, with deep insight on China, will join us. We will get her analysis. Stay with us. This is Bloomberg.
can't seem to get enough of Prada. Loafers, nylon bags, and its Miu Miu micro miniskirt have been flying off the shelves into and onto the arms of young consumers. Fashion tech company Lyst placed Prada second on its fashion index, at its highest ever ranking. So what could be making this over a century-year-old fashion house appealing to a new generation of consumers?
What Prada has navigated adeptly is their overall kind of understanding of how cultural conversations are happening online, their ability to partner with various cultural figures.
Gen Z faces are at the front of Prada's advertising to this new market. Maya Hawke, Hunter Schafer, and Sydney Sweeney will be familiar to any fans of Stranger Things or Euphoria. There could be another factor at play, the environment. Of those surveyed by The Lancet, over 59% of Gen Z said that they were extremely worried about the climate crisis. So, for example, the revival of Prada's iconic nylon handbag using eco-friendly materials may be winning kudos among these shoppers. Of course, Prada and Miu Miu are not inexpensive brands, and as the global cost of living crisis hits, these brands might start to feel a pinch. But, for now, Gen Z seem to be reaching for their nylon handbags and not letting go.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Markets. I'm Tom McKenzie in London. Now, officials in Washington and Taipei have been in touch since US President Biden met Chinese leader Xi Jinping at the G20 summit, where the leaders agreed to take steps to ease tensions. This comes as COVID cases hit a record in China. For the latest, let's bring in Tina Fordham, Global Foresight founder and geopolitical strategist. Tina, thank you so much for joining us. Let's start with that meeting then. There seems to be something of an easing of tensions, as we said there, between the two leaders. We had the defense secretaries as well of both nations meeting earlier this week. How substantial is this, and to what extent can this be sustained, particularly as we consider that maybe the next head of the House, Kevin McCarthy, could be on his way to Taipei and Taiwan at some point in the new year?
Yes, indeed. Well, I mean, I think the broad takeaway of the initial meetings at the G20 between President Biden and Xi was de-escalation and an improvement in what diplomats call the mood music. I'd say it's too early to talk about a kind of a soft landing in geopolitical terms between the U.S. and China because the stakes remain very high. But I think we can genuinely take comfort from what was clearly a meeting that was orchestrated carefully on both sides to communicate areas of cooperation on climate and to de-emphasize areas of disagreement. We're still not back at what I used to call the frenemies relationship. It is a more hostile relationship these days, but everybody's toned it down, and that's positive, no question about it.
Yeah, so they're attempting to reset those communication channels, those links between the two militaries over concern, of course, that there could be a flashpoint, and think in particular around the Chinese military response around Taiwan. But at the same point, as you say, also looking at greater cooperation around things like climate change. Prior to the meeting, of course, you had a very substantial move by DC, by President Biden, around restricting tech flows, particularly semiconductors to China. So how should we be thinking about all these different factors when it comes to the question of decoupling, or at least a realignment of these linkages, these trade linkages between these two nations?
Well, it's a nuanced answer, right? As you mentioned, the U.S. move on banning chip technology is a real blow to China and will be seen by Beijing as an attempt to constrain its rise. What I see in my conversations in boardrooms and with investors is a real pullback away from the previous narrative we had about China's inevitable kind of eclipsing of the U.S. and the West. There's a sort of a China fatigue as well. And yet, unlike the U.S.-Russia relationship, which is not important in economic terms, but important in geostrategic terms, the U.S.-China relationship, and indeed the EU-China relationship, is of huge importance, both economically and geostrategically. And so finding ways to remain productive is crucial. I think the takeaway for investors, and especially multinationals, is that the scrutiny of all transactions, whether tech or M&A, for geopolitical components is going to be very high. We saw that with Olaf Scholz's recent trip to Beijing and the Chinese 25% stake in the port of Hamburg. Very controversial.
So that scrutiny will continue of some of those transactions. When it comes to the question of COVID zero, we've had a 20-point plan from officials, and now you also have COVID cases at a record high. What is your best assessment, Tina, as to when they're able to get out of COVID zero? Are we looking early part of 2023 or not until the end of that year?
Well, we're kind of, you reminded me of going back in time to the bad old COVID days where you had a lot of people who didn't understand pandemics making prognostications. I mean, the Chinese are stuck with zero COVID, because as soon as they take those restrictions off, it's quite clear they're going to be faced with a massive influx of cases to their already overstretched hospital system. And yet many of the global investors and multinationals that I talked to really expected after the Communist Party Congress that those restrictions might be lifted. It's going to be very difficult for China to do that anytime soon. And it's hard to see a big move in that direction, which means suppressing growth, of course, and really extending the trajectory for a recovery of China in the economy.
Yeah, having lived there for 5 years and still in contact with a lot of people in Beijing, that post-party Congress view on relaxation did seem naive to me. Tina, I know before we want to let you go, you do have strong views on what is happening in terms of what the Financial Times described as a conspiracy of silence around Brexit. You're saying that that's starting to crumble now. What is happening here in the UK when it comes to the question of Brexit, and what are the broader implications?
Well, not before time, right? I mean, it really was impossible for many leaders, and indeed for Conservative Party leaders, to use the B word, Brexit. And there has become this almost, kind of a religious or a zealotry around it, making Brexit work. That's what led to Boris Johnson coming to power and getting Brexit done. Well, now that the kind of pandemic aftermath has, the fog has lifted, there's really no other explanation for why the UK is at the bottom when it comes to our OECD peers. I'm based here in London, other than Brexit. So finally, you've got Jeremy Hunt, the new Chancellor, and Rishi Sunak, the new Prime Minister. By no means, they're trying to avoid betraying Brexit, as their predecessors brought in. But we are finally having a conversation about how to improve relations with the EU because the economic costs have just been too high.
Yeah, and the polling suggests that the people of Britain are getting pretty fed up with Brexit as well. They are now not in favour of this arrangement we have with the EU. So we'll see what happens on that front. Tina Fordham, important analysis and insights both on the US, China, and the elephant in the room when it comes to British economics, which is, of course, Brexit and the impacts. Thank you. Now it is time for the Bloomberg Business Flash and a look at some of the biggest business stories in the news right now. I'm going to go back to Laura Wright. Laura.
Thanks, Tom. Thousands of Amazon warehouse workers in about 40 countries will mark Black Friday with protests and walkouts. They are demanding better wages and working conditions in a campaign called Make Amazon Pay. Employees in the US, UK, India and Japan are among those taking part. Amazon says it takes its role seriously on what it calls these important matters. More cuts reportedly at Twitter. According to the Financial Times, the social media platform has disbanded its office in Brussels after key members of the staff left. Twitter's two heads of digital policy in Europe quit last week. That's the Bloomberg Business Flash. Tom.
Laura Wright, thank you very much indeed. Now, still ahead, billionaire investor Bill Ackman, yes, he is betting against the Hong Kong dollar. That conversation is going to come up with Jeremy Stretch of CIBC. We'll get Jeremy's calls on the euro, the pound, the dollar, as well as that view on that short position on HKD. Stay with us. This is Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to Bloomberg Markets. I'm Tom McKenzie in London, checking in on your markets for you this Thursday, this Thanksgiving Thursday, of course. Here in Europe, you're seeing gains of 0.4%, still holding on to some upside then. Most sectors remain in the green, every single sector, in fact, apart from energy. Real estate at the top of the list, a gain there of more than 2% for that sector. And in terms of your futures in the US, of course, closed trading today, but you did see a close for the S&P, its highest levels in 2 months yesterday, holding above 4,000 on the S&P, and you're looking, the futures pointing to gains when they reopen of around 0.2%. There's been a move as well into government debt in Europe, most pronounced at the long end, 185 on the German Bund, the 10-year, so that's a move lower by 8 basis points. The pound has also bid up 0.5%. We'll get Jeremy Stretcher's views on the outlook for sterling shortly. 121 on the pound, partly on the back of softer dollar, but also maybe some commentary from the Vice Governor of the Bank of England. Now, the Hong Kong dollar is also an FX story for us. Weakness reversing with one billionaire investor revealing his big short against the peg. Pershing Square's Bill Ackman tweeting, quote, "We have a large notional short position against the Hong Kong dollar through the ownership of put options. The peg no longer makes sense for Hong Kong, and it is only a matter of time before it breaks." Joining us now is CIBC Head of G10 FX Strategy, Jeremy Stretch. Jeremy, let's kick off here then with Bill Ackman's short on the Hong Kong dollar and the peg.
Hi,
They do have the FX. Hello, Jeremy. They do have the FX reserves. His argument would be it's so entrenched now with China, it just does not make sense to have a currency that is pegged to the US dollar and the machinations of the Fed.
Well, yes, you can certainly make an economic case, or at least a business case in relation to Ackman's view. But of course, Bill Ackman isn't the first of the sort of the titans of the FX space who tried to bet against the Hong Kong dollar peg and have proved to find it's relatively difficult to actually push that through and actually achieve that success that they're aiming for. So, yes, you can argue that the rationale is potentially questionable. Yes, you can argue that eventually there will be an adjustment in terms of that process. But in terms of actually positioning for it at this particular juncture, well, it could well be a long and drawn-out process, which often suggests that the HKMA may have deeper pockets than those that are betting against it.
Yeah, they're certainly in a much different place, aren't they, compared to the Asian financial crisis in terms of those FX reserves. Jeremy, when it comes to the dollar,
exactly.
We're seeing weakness again in the session, down 0.3%. We had the FOMC minutes. It seems that the size of these rates is going to kind of moderate, maybe to 50 basis points. There's seems a lack of consensus within the FOMC about the ultimate terminal rate, though Jay Powell, of course, has said he thinks it's going to be above that dot plot, 4.6%. How does that feed into your views on dollar as we look into 2023?
Well, I think if you look at the way that the dollar has performed through the course of 2022, it has been very much a function of how the market has priced the Fed terminal rate. So as we've aggressively raised up those terminal rate expectations through the course of the last few months, then that has been commensurate with the increase in the dollar's value, whether it be in the BBDXY or the DXY itself. So I guess the question is whether you think that the market is now correct in pricing a terminal rate of around 5%, which I think is probably pretty much correct. But also then you have a presumption as to how long the Fed will maintain that particular rate level. But ultimately, it is a case that the dollar has been gaining on the base, or gained through the course of this year on the Fed story. But I think that Fed narrative is going to start to lose momentum as we go into the beginning of next year, as we reach those terminal rate assumptions. And I think then we're getting to a scenario where we're getting much more two-sided in terms of the risks. And particularly if we start to see some of the leading indicators globally looking a little better, then we may well find that this recovery in the high beta currencies could have further to run. Although I would be wary about buying some of them at these lofty levels in view of some of the significant gains we've seen over the course of the last couple of weeks.
I feel like it's a slightly clearer picture for the dollar than the euro. You can correct me if I'm wrong, but when I look at the euro, we've got comments out just in the last few minutes from officials from the ECB saying, yes, they're going to have to hike further. You're having some data coming through from countries like Germany. It's kind of slightly less bad than maybe some economists have suggested. You've got the talk around the energy price cap. What is the biggest factor now for the euro as it holds above parity today?
Yes, I think there are a number of cross currents, and in a sense, I think if you look at the data, it has been gradually improving, or at least exactly as you say. I think it probably implies that the scale or the depth of the recession is perhaps going to be slightly shallower than markets were assuming. I think we may well get to a scenario where the ECB is going to be also more mindful about some of those growth challenges we move through into 2023. So I think from our perspective, we are looking for a lower terminal rate than is currently priced by the market. But we don't necessarily see that as a particularly negative story for the euro, because I think it may well be the case that the market will focus on the ECB providing a little more constructive, or focusing a little more on trying to drive the growth trajectory, and the euro benefiting from that globalized recovery narrative into 2024. But I think the gas story remains relevant as far as the eurozone is concerned, and or the opportunity just to pare back some of that extreme negativity that had been priced in over the course of the last few weeks, when we did see those substantial moves well beyond that parity threshold of which we're trading comfortably above now.
Yeah, 104 on the euro dollar, 104 on the single currency, just up 0.1%. So the cross currents of gas still focus on that. When we switch focus, Jeremy, then to the pound, and that's getting a bid today, up 0.4%. 121. Would you have envisaged that the pound would be at these levels at this stage? We're still kind of digesting the pretty negative impact of the autumn statement, and the politics of the UK still looking vulnerable.
Well, yes, that's right, and I think that David Ramsden did make reference to the fact that obviously the UK's credibility is and has still been compromised to an extent by the events over the course of the last 2 months, because of course it is just over 2 months ago that we had that rather spectacular mini-budget own goal from the previous governmental regime. So we've been reducing that credibility deficiency that has really, or had really, afflicted UK assets, and so we've really been seeing short positions covered fairly significantly. Now, of course, we still have the Bank of England predicated towards monetary tightening, but I think despite some of the references we've seen from Pearl and Ramsden over the course of the last couple of days, that I think the topside risk in terms of UK rates is still substantially lower than currently priced by the market. But we are cleansing positions. But I think as we get somewhere nearer the 200-day moving average, which comes in shy of that sort of 122 threshold, I think then that would probably mark this current uptrend. And as long as we respect that 200-day moving average, I wouldn't be surprised as we move into December. We might just see a little bit of reduction in terms of these sterling gains as we do move increasingly into somewhat overbought territory.
Okay, so maybe 122 marks the cap for the gains that we're seeing in the pound as we weigh up, of course, the economic impacts here in the UK, but also some political strife that continues as well for the new Prime Minister. Jeremy Stretch, always excellent. Thank you so much. CIBC, head of G10 FX strategy, with that analysis on the pound, the euro, and of course, where we see things with the US dollar. It's starting to top out. Keeping up to date with news from around the world then, let's get the first word news with Bloomberg's Laura Wright. Laura.
Thanks, Tom. In China, daily COVID infections have risen to a record high. The country reported almost 30,000 new infections on Wednesday. The recent surge comes at a critical moment for leaders. They have to decide whether to tolerate some spread of the virus or revert to strict COVID-0 restrictions that could hurt the economy. Meanwhile, European Council President Charles Michel will travel to Beijing next week to meet with China's President Xi Jinping. The EU has been struggling with how to treat China, while the US presses for a tougher approach. The EU's relationship with China has been strained by Xi's ties to Russia and China's refusal to condemn the invasion of Ukraine. In Malaysia, longtime opposition leader Anwar Ibrahim will become Prime Minister after decades of waiting. The country's king chose Ibrahim to form the next government. No alliance was able to secure a majority in last Saturday's election, but Ibrahim's coalition won the most seats. Inflation in Mexico slowed down more early this month than economists expected. Still, one key price metric accelerated. Consumer prices rose a little more than 8.1% the first 2 weeks of the month from a year earlier. But core inflation, which excludes volatile items such as fuel, sped up to more than 8.6%. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. Tom.
Laura, thank you. Now, French cognac maker Rémy Cointreau is reporting higher first-half profit and expecting a return to normal consumption following 2 years of exceptional growth out of the pandemic. CEO Eric Vallat telling Bloomberg that a 5 to 10% price increase is a good benchmark. Take a listen.
The growth will definitely and hopefully come from China on our side. This is the way I look at it. Obviously, I'm not speaking for the very short term. We hear about measures that are being taken this week, which are not going to help in the very short term. But if you look at China, the prospects are very positive. The comps are probably easier than they have been in the past, and the wine and spirits account for only 1.5% of the total spirits consumed in China. And every time the rules against COVID ease, we see consumption back. We see a strong appetite for our products. You know, the last example I have in mind is we had 3 brand days in Plaza 66, which is the most prestigious luxury mall in Shanghai last weekend, and we hit record sales. Traffic was absolutely huge. We gathered something like 600 VIPs in our boutique, which was truly amazing. And now Shanghai is locking down again. So, you know, the learning from last year anyway, so we have to adapt. We have to be flexible.
Okay, you have these monster moments, I suppose, when you get the reopening. I had Moët Hennessy. They're running out of champagne. Have you got enough stock? Are you fully stocked? Are you carrying extra stock? Are you ramping up preparedness for the reopening?
We are ramping up for sure, preparing for the reopening and again adapting to the environment. We were hit, for instance, in May last year because we had only one warehouse in China, which was based in Shanghai, and Shanghai was locked down. Now we have 3. So we are preparing this way as well, you know, from a logistics standpoint. On the liquid front, we've been running out of stock for the past 2 years as the US were booming dramatically. We are now in the process of recovering a good level of stock, even though our stocks are still very low in China, for instance, while they are now improving in the US. But clearly you see celebration, you know, whether it's in, whether... Sorry, please.
Sorry. No, well, I suppose the natural corollary to that is, I mean, it's a beautiful premier product. It's already moderately expensive to have. So do you squeeze it? Are you going to raise prices given the restricted supply and the issues around that? What is tolerable for your average client? Are you going to raise prices 5%, 10%? Just give us an indication.
Between 5 and 10 is a good benchmark. Huh? Just so you know, prices, in fact, inflation, current inflation is creating a positive context when it comes to managing prices, obviously, and it's favorable as such. But if you drive your price, depending on inflation, you take risks for your brand. So for us, in fact, pricing is driven first and foremost by pricing power, which comes from the quality of the product, the desirability of the brand, the quality of the experience you can propose to your clients.
And that was the CEO of Rémy Cointreau, the cognac maker there, speaking to Manus Cranny. The stock, by the way, currently down around 0.5%. Broadly across these markets in Europe, you're seeing gains of 0.3%. Futures in the US pointing to upside of between 0.2 and 0.4%. Coming up, we are live to Brussels, where EU ministers have hit a roadblock on an energy crisis deal. We're going to bring you the details on the ground with our very own Maria Tadeo. Stay with us for that. This is Bloomberg.
today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to Bloomberg Markets. Now, Italian energy company Enel planning to offload 21 billion euros worth of assets to reduce its record debt pile. I spoke with the CEO, Francesco Staracci, alongside my colleague, Francine Lacqua, on the sidelines of Enel's Capital Markets Day. Take a listen.
The buyers are out there. In fact, they are actually more than willing, and that's one of the reasons why we decided to put some of the assets on sale. I mean, we think that there is good moment for gas assets, for example. This was a new decision we took in the light of what gas's value is today, and I think the debate we just heard shortly before this interview was underlying the importance of that. And we are going to focus our presence in all the countries where we can have an integrated play, which means help our customer go through this electrification journey the best way possible. And some geographies that don't fit within this scheme are going to be sold to buyers that at the moment are quite hot on them. So we see very little risk on the execution side. In part, 5 out of these 21 billions have already been executed during 22.
Francesco, it's Francine. Good morning. So the rationale is really to be able to better service your clients in the limited number of countries that you'll be more present in?
Exactly. We have 6 core countries, as we have decided to call them, that are basically Italy, Spain in the European continent, the USA, and in Latin America, Brazil, Chile, and Colombia. These are countries where governments are really committed to electrify and decarbonize the economy, and we have masses of customers that are going through this huge change. I think that's where most of our technology and our know-how lies, and that's where we want to focus our efforts. Elsewhere, there is value to be created for other investors, and we're going to streamline our operations in order to really concentrate on where our skills are best put to work.
And I know there's a big focus for you and the team on the US, and you've won that license now to provide renewable energy to businesses in the United States. Obviously, the Inflation Reduction Act, a big part of that. Just detail for us your ambitions within the US market. You have that license. What is the end goal for you and Enel in the US?
The growth space in the U.S. is really large. It's been like that for a long time. It's now with the IRA, I think we have a much more stable 10 years horizon in which you can plan your efforts. And part of that is that we want to couple a very strong growth on the generation side with renewables. We're adding roughly 1.5 to 2,000 megawatts every year going forward in the next few years, and as we've been doing so far, with a growth on the business customer base, and you see that starting from the Texas license. We want to really start becoming a retailer on the business side, and I think that's a very promising growth area for the U.S. So not a regulated business, but a customer business coupled with our generation. On top of that, don't forget, we are the second largest or the first largest operator on demand response. So we already have a big presence in that very interesting market.
Okay, the CEO of Enel there, one of the biggest energy companies in the world, on the opportunities they see in the US, particularly around renewables. Sticking with energy, the European Union is set to pause efforts to approve a package of emergency measures to curb fallout from high natural gas prices. That's as diplomats try to resolve what is becoming a deep split over a push to cap the cost of gas. We are joined now from Brussels by Bloomberg's Europe correspondent Maria Tadeo, has been watching all of this and following this very closely for us, as well as speaking to people and those involved. Maria, what is the state of play then? Is it disastrous that this has been delayed? Where are the gaps? Where are the divisions?
Yes, and it's a very good point, but I would best describe this as this is typical Brussels. Nothing is agreed until everything is agreed. So essentially, you find yourself in a situation where energy ministers have not fully rejected the package put forward by the Commission, but they cannot fully endorse it either. So it's now on hold, as you know, until December 13th. Well, we'll reconvene again here in Brussels. So expect to find me here again debating this package. Now, the sticking point is very well documented. In fact, we've heard it repeatedly the entire morning. Those who want to see a price cap say that at 275 euros megawatt hour for 2 weeks, this is not a real price cap. It will never be triggered. Some of the language here quite feisty, some suggesting and saying this is almost like a bad joke. It is badly designed. It is a mockery. And of course, on the flip side, the other side of the spectrum, I spoke to the Dutch energy minister who told me the more this debate drags on, the more obvious it is becoming that a price cap on gas is a flawed concept and that it will create or could create serious disruptions in the supply market for Europe, especially at a time in which it is already running very tight, very expensive.
Maria, do these divisions play into Vladimir Putin's hands, or is that overreading it?
To some agreed every sanctions package by unanimity. This is always what makes the European Union work slow, but it's also the strength. And that is exactly what I heard from a number of diplomats who say overall they agree on the package, except for this one key point. The issue is that you either approve everything or you reject everything. But it is true that at this stage, Tom, I've lost count of the amount of energy ministers' meetings that I've seen. The timing now is cutting it very close to Christmas. We know there's going to be a cold snap. The heating season has already started. For a lot of countries, they really feel the pressure in home bills. And of course, when you look at the timing of this meeting, this is December 13th. It is right before the European Central Bank hikes rates again, and European leaders meet for the final time this year. What can they do in the space of a week they've not been able to accomplish in 3 months? That's a big question.
All right, so the clock is ticking on that front. So we've got the gas side of it, which you've outlined and detailed for us very, very clearly indeed. And then there's the oil question and the G7's attempts to put a price cap there. Maria, any progress?
Which again, Tom, European officials will have to debate. The idea that we have is that this will be a late discussion. Of course, you have to factor here the time difference between continental Europe and the United States. They would want to check, I presume, with their U.S. counterparts on the final point. The sticking point, again, is that price point. There has been, ideas floated, anything from $65 a barrel to $70 a barrel for some, including the Polish, which, as you know, have been very tough on Russia since the war started. They still feel this is way too generous for Russia, and you have to go back to basics. The idea of a cap is to deprive Vladimir Putin from having this revenue that's maintaining his war effort. In reality, that's not manifested. Is Russia going to end the war quicker because of a $65 a barrel oil cap? For many, well, this is not an energy question. It's political, so this is not really going to have a lot of impact, but we are expecting, and we're being told, potentially a deal within reach today.
Okay. Excellent. Maria Tadeo on the ground in Brussels on all things gas and oil. Thank you very much indeed. That does it for this hour of Bloomberg Markets. I'm Tom Mackenzie. I'm going to leave you with pictures, live pictures of the Macy's Thanksgiving Day Parade. This is in Manhattan, 2022. People prepping their turkeys and their pumpkin pies. Look at that. Only the US does this and does this well. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So, US markets closed for Thanksgiving, but here are the top market stories that we're following for you around the world at this hour. The boss of Binance telling Bloomberg that he will amass at least $1 billion for his industry rescue fund. CZ Zhao also indicating that he will make another bid for the bankrupt lender Voyager. The Fed pointing to a rate hike slowdown. The Bank of England says it will raise rates regardless of the pain. And in Sweden, the Riksbank delivers another 75 basis point hike. We are going to hear from its governor, Stefan Ingves. And China's COVID cases hit a record high, exceeding April's peak. The news calling into doubt any exit from strict pandemic curbs. Welcome to Bloomberg Markets. Happy Thanksgiving, if you happen to be in the United States. Let's talk about what is happening. We are still reacting, of course, to the moves we saw yesterday from the Fed out of the minutes. Equities generally getting a boost on the back of them, confirming basically the minutes that we are going to see a slower pace of rate hikes. I think we all knew this, though, didn't we? Basically, the signal was a very clear one. We are moving to a 50 basis point increase next month. That is the base case now. Ella Hoxha, Pictet Asset Management Senior Investment Manager, joining us now. This didn't come as much of a surprise to me. Should it have come as a surprise?
I mean, we've had quite a bit of tightening in terms of rate hikes this year, but also in terms of QT, so taking liquidity out of the market.
Yep.
So I think the market's been anticipating for some time that we're getting this so-called pivot, or at least, for lack of a better term, at least a peak in rates from the Fed.
Is this the beginning of the pivot? I don't think we can quite call this the pivot yet, but is this the starting of that process?
Right. I mean, we would probably steer away from calling it a pivot, but we would say
pre-pivot
at least. So 5% peak in rates from the Fed is currently priced in markets. Difficult to argue with that, given that we have a persistent drop in inflation, likely to be the case certainly in the next 6 months. But beyond that, there's very little visibility. Historically, we know that it takes a lot longer to bring inflation back to the mean once we've broken these types of level that we've done this year. And so for that, we're a little bit more conservative in terms of whether this is really indeed the peak in rates in the U.S. But for the next 2 quarters, it might well be.
So the risk lies to the upside. How big, if we go beyond, say, circa 5%, how much beyond that could we have to go?
Well, 6% is possible. We're not necessarily calling for that. In fact, over the past month, we've been adding some exposure to the U.S. because it's probably one of the more attractive markets on a real yields basis. But beyond that, the risks are certainly skewed to the upside and become a little bit more symmetrical once we get to, say, 3.5% in U.S. five-year yields.
How are you factoring in the dollar into that thinking? It's been very easy to move money into the United States. You've picked up, obviously, the increase in the currency. Has that now turned as the dollar peaked?
We're definitely not in the camp that thinks the dollar has peaked, actually. And the reason for that is, relative to other central banks, the Fed's been far more adamant to fight inflation. And related to what I was saying earlier, that fight is far from over. So with that in mind, it underpins the dollar on a more medium-term basis from our perspective. That's factor number one. The second one is there are still risks in the system that we have yet to see. We've seen a few implosions so far, but there are still potential other risks in the pipeline which would underpin the dollar, as is a tighter dollar liquidity, more broadly speaking. So for global portfolio managers, the dollar has a crucial role to play in terms of diversification or tail risk protection.
Okay, so let's talk about those tail risks. Let's talk about those risks. Are they, to use the vernacular of Donald Rumsfeld, are they known unknowns? Do we know what these risks look like? Right. The implosion of FTX obviously is maybe one you're referring to there. As liquidity is withdrawn, we may be starting to see some of these liquidity issues emerging, and they can move pretty quickly. But are there other areas you're looking at?
Well, private assets, potentially one of those areas. There's been quite a bit of growth in that asset class over the past, well, more than a decade at least. So that's a potential area where, you look at the private equity index that's already showing a 56% decline year to date. So those are potential areas. Of course, we saw what happened with gilts, earlier in the autumn. So potentially that's another area. So pensions and the sort of the asset exposure and capital calls of pensions, real estate. I mean, there's so many that you can pick. It's very difficult to pick one. But I mean, it's what we see when rates reprice significantly, as we've seen this year. We tend to see where the bodies lie, so to speak.
Yeah, they're beginning to float to the surface now. It's a nice image. Let's just think about, therefore, what we are doing as asset allocators. How are you thinking about the world right now? What I'm increasingly hearing is that people have been in cash, but now they're starting to think about getting back into treasuries. They're starting to think about getting back into government bonds more broadly. Then they're thinking, do I want to get into credit, high-grade credit? Is that the next place to go? I'm just wondering how you're thinking about how you're going to sequence that sort of re-asset allocation decision-making process as you work your way through out of 22 into 23.
Sure. I mean, it's something that we've been certainly doing. First of all, markets where it's interesting. I mentioned treasuries. Treasuries look interesting, and I believe that's probably the case with a lot of our counterparts in the market.
Yep. Short or long?
Long.
Okay.
Long, but
no, I mean
sort of
duration.
Smaller scale. Small, long in duration is probably a good place to start. And as I expressed earlier, the longer end of the curve, because we still have to navigate this risk between growth and inflation, right? So it's far from clear. Europe is less attractive to us, certainly on the core bond space, but it might be looking a little bit more interesting in credit space. And the reason for that is because we think the European Central Bank might take more risks with inflation, which typically would favor some of those debtors in credit space. So that's one area where we started covering our shorts and looks interesting to us. USIG looks a bit more tricky because of the risk that we mentioned, both on the recessionary side or on the other tail, on the inflationary side. But in, the framework we're using is really this real rates framework. So look for markets where, A, there's more credibility from a central banking perspective, but also there's more positive real rates. And there aren't that many, but you get some. So for example, we mentioned the US, Korea is an interesting one also because it's seeing quite a weak cycle. But also in terms of emerging markets, you have places like Brazil, Mexico, South Africa, etc., where you're getting some positive real yields. Another thing, something else we're doing on the asset allocation side is looking at those markets where there's high sensitivity to the real estate, market in general. So places like Scandinavia, the Antipodeans, Canada, they're markets that we like on a relative basis in rate space because there are pertinent risks coming from housing and the repricing in rates.
Can I just come back and explore a little bit more the idea? Would you sequence into European IG before you'd sequence into US IG? And if so, kind of why? I've heard this before. I've heard a number of credit managers talking about this. Europe at the beginning of next year, the US at the back half of next year. Once you start, is that the right way of thinking about it?
So up to this point, we have favored the US, mostly on the credibility front. However, what we're seeing now is this type of environment where more inflation is tolerable, as I was saying, is probably quite protective of not just credit markets, but also the periphery. And we've seen that with Italy. Italy's traded much tighter in spread to bonds over the last few months because it does like this type of environment where perhaps growth is not necessarily falling off a cliff in Europe, so a milder recession, but also a little bit more inflation. If you're running high debt to GDP, that's not a terrible combo, at least over the short term.
Longer term, maybe a little bit more tricky. Let's get to stick with us. We're going to migrate more into having a conversation about what's happening in Europe. We've seen decent PMI data actually out of Europe yesterday, maybe pointing to a slightly shallower recession than people had talked about. And then you've got the EFO data maybe confirming that as well today. We've also got to think about what the Bank of England is doing in all of this. The Bank of England's Deputy Governor, Dave Ramsden, talking a little bit earlier on at a Watchers conference, calling for another 75 basis point hike in December, even if that causes households more pain. We're going to talk about this debate next. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
So let's talk about what is happening in Europe. In the UK in particular, inflation is running hot, just over 11%. So the Deputy Bank of England Governor, Dave Ramsden, says the central bank must continue to raise interest rates, even if it means more hardship for households. He was speaking at a Bank of England Watchers event that has been taking place today. Joining us now to discuss this is Bloomberg Managing Editor for Markets, Christine Aquino. Christine, the Bank of England has, to my mind, tried to sound like it wants to do less. It's tried to sound like it wants to be cautious, but the inflation in the UK looks much stickier than it's going to have to be than it is elsewhere. And as a result of which, maybe the bank is going to have to be even more aggressive and go even further.
That's exactly the dilemma that they're in, Guy. And I think it's still up in the air whether the BOE will go that route, as you say, really aggressively going after inflation when they're very much aware, and they've told us as much, that there will be a recession. It's inevitable at this point. And so this is a very difficult situation that the Bank of England is in, particularly, I think, in the UK, more than the other central banks, is that, again, that runaway inflation, but also a nearly guaranteed recession right around the corner.
The bank does a number of weird things, one of which is base its forecasts on where the market is currently signaling rates will ultimately go. And it's basically tried over the last few weeks, and certainly the governor's been front and center in this, to talk the market back from the aggressive pricing that have been put in, up to, say, circa 5%. But given the data, and given what we hear from Ramsden, maybe the market had it right all along.
Yeah, and definitely a valid question to ask, Guy. I mean, we did see markets in the aftermath of that BOE messaging. They did heed the governor's message that, perhaps rates may not need to be as high as markets currently expect, but then also that's just one input for the markets, right? As you say, they're also looking at the economic data, and by most accounts, we are still seeing a lot of signs that inflation is here to stay. It's going to be sticky. It might be a big task for the Bank of England to really bring that down. And so, it might be a bit of a chicken or egg sort of situation here over the next couple of weeks, where markets kind of start diluting that message from Governor Bailey and the Bank of England a few weeks ago, to kind of start looking more concretely at the data and realizing, well, hang on, I think the Bank of England might have to do more than they actually communicated.
Absolutely. I was talking to Chris Williamson, who puts the PMI data together yesterday, and he was certainly indicating that inflation in the UK looks much more sticky. Christine, let's just talk briefly about the pound, though. We've now got a cable rate, and I can't quite believe my eyes here, 121.22. It wasn't that long ago that we were talking about the idea that we would potentially have parity against the dollar. We've moved aggressively away from that. Does that help the Bank of England here? The terms of trade crisis the UK is experiencing right now has energy at its core, and energy is priced in dollars.
Absolutely, Guy. I mean, I think, you know, a weaker currency had certainly played a part as to why inflation was such a big problem, especially over the summer. And we all know Economics 101 tells you that a stronger currency is certainly helpful in the inflation fight. So I'm sure this is a development that the Bank of England is probably a little happier about seeing the pound at these levels. I guess, you know, it just depends on how sustainable it is from here, right? Because I think what we're seeing in the markets, particularly this week, is not necessarily a UK-specific factor. It really is more to do with the weaker dollar as a result of those Fed minutes. How sustainable it's going to be at these levels is still yet to be seen.
Well, let's try and get an answer to that question. Christine, thank you very much indeed. Bloomberg's Christine Aquino on what is happening in the UK. Let's talk about the UK and what is happening more broadly in Europe. Ella Hoxha, Senior Investment Manager at Pictet Asset Management, still with us. I'm stunned to see the pound back up at 121. Do you think this is sustainable? Is this something that investors should be taking advantage of? If you're a UK-based investor right now, should you be going out there using that stronger pound maybe to buy foreign assets?
Stronger pound. I mean, I'm happy as a UK resident. Clearly, higher is better for us. But I mean, broadly speaking, you know, what concerns us about the pound is exactly what's concerned us for the last 3 years, really. And it's sort of the structural growth story, which we know is not a great one. And that's not a problem that's been fixed. It requires reforms. And so we're far away from that. And we've added to that now a much stickier inflation, as we were just saying. And so, again, you're back to the sort of real rates ideology, so to speak. You know, you're probably getting robbed as a PM in terms of owning nominal yields in the UK. So we still don't like the rates or the currency here, actually. Going forward, it is a little bit of a dollar call, and you know my thoughts on that. We talked about it earlier, so we still don't think we're out of the woods in terms of the dollar up move. So we would probably be more on the bearish sterling camp. Not supported by the fact that the Bank of England has probably been the shyest of the major central banks in terms of lifting rates in the face of double-digit inflation.
Do you think it's got to do more? The sense from the bank over the last few weeks has been actually the market's got it wrong. We're not going to be going that far. There is a recession coming. We're not going to have to go as high as 5% or whatever it was that was priced. Is the danger actually that they do?
Well, the danger is that they're risking too much in terms of policy stability, and that's certainly been our view for some time now, pre this whole budget fiasco. So we would argue potentially they will have to be doing more. They may get some cover from slightly falling inflation and a potentially recessionary picture on the next 2 quarters. But beyond that, we think the inflationary story is still probably the dominant theme, and the structural weakness story is the dominant theme. So I think that will fail to support UK assets in a major way.
The news out of the Eurozone over the last couple of days, I thought, has been quite positive. The EFO number this morning, okay, it's a relative, it's a relative starting point. Less bad.
Less bad, yes.
The EFO number today, the PMIs yesterday, pointing to a shallower recession. However, I don't know what's going to happen in Europe this winter. I don't know what the weather's going to be like. It feels like that ultimately that's kind of what we're all hostage to right now. But the data at the moment look much more positive. What does that mean in terms of policy? What does that mean in terms of how you allocate assets?
Well, first of all, it might be interesting for the euro, actually. The euro might be a bit of a different story next year. If indeed the recession is much more shallow, it should be supportive of the currency. The ECB, on the other hand, is withdrawing liquidity through its TLTRO program. So that should also support the euro to some extent. Valuations support the euro, so does positioning and general bearish sentiment. So there could be something there. We think it's still early to tentatively try that story, but it's potentially something that can shift in upwards, and that would help the ECB with its inflation problem. In terms of more policy pertinence, a better backdrop on growth would give the ECB less cover to be slower in terms of hiking rates. So you can actually get potentially higher rates in Europe as well. So that is the risk. And so hence it probably supports a more bearish view.
So good news is bad
news. I really am not a big fan of that analogy, but I guess you can say so in this case, yes.
How high do you think the ECB is going to have to go?
Well, I mean, I think even the ECB itself doesn't know. I mean, this whole concept of neutral rates, you know, you can debate, is it 2%, is it 3%, should it be higher in this sort of regime? I think we just take a step back and say, well, they're going to probably go less than necessary because of the weaknesses in the system. And we know what these weaknesses in the system are. It's the periphery and the debt load of the periphery countries. And so with that in mind, we think they'll be able to tolerate more inflation because it's a form of financial repression, right? So you erase debt by doing that.
Let's just talk a little bit about equities. We haven't really touched equities very much thus far. They seem to be the first for people's minds in terms of where they want to allocate assets at the moment. If Europe has any good news, if the recession is less bad, if the winter is less bad, how much of a coiled spring do you think there is for money to go back into European assets? They have been significantly more beaten up than their US counterparts.
Well, when you look at the European indices, a large component of those is banks. So you have to be super constructive on the cycle. Now, if you're coming from a very low base, the only way can be up. And as I was saying earlier, allocations to European assets are pretty bearish. You could see it in the Bank of America's fund manager survey that the most bared up is Europe equities. So there is some room to go. And if you get some buffer from your euro sort of moving up as well, you can benefit both ways. So there's an argument to be made, but I would say it's probably a bit more tactical. To make a structural argument as to why Europe equities should outperform in a significant way is a little bit tougher. But then you're asking a bond PM, right? So
Well, no, I'm just curious as to bond manager seems super happy at the moment. Equity guys seem to be much more pessimistic about the world. Right. But I'm wondering if there is an opportunity in Europe, because it's so beaten up.
Right,
it's so, and I'm just kind of wondering at the margin.
Where is it? Yeah.
You guys have had a really tough time with things over the last 10 years in the bond world. Equities have having a very short-term time frame sort of hit, but maybe we do start to get maybe that opportunity if things don't look quite so grim in Europe. Anyway, Ella, nice to see you. Thank you very much indeed for joining us. Ella Hoxha of Pictet Asset Management. In the next hour, we're going to get more insight on central bank policy. The Riksbank Governor, Stefan Ingves, who is stepping down, remember, the Swedish Central Bank today delivering another 75 basis point hike. What comes next? This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Three minutes past the hour. It's time for a Bloomberg Business Flash to look at some of the biggest business stories in the news right now. Let's start with thousands of Amazon warehouse workers in around 40 countries looking to mark the Black Friday with protests and walkouts. They're demanding better wages and working conditions. Amazon says it takes its role seriously on what it calls these important matters. And at a time when Twitter faces increasing regulatory scrutiny, it has lost its last remaining employees in the regulatory hub of Brussels. The small office of 6 employees was cut to 2 in recent weeks in Elon Musk's layoffs following Musk's dramatic culling of staff. The remaining 2 members left over the last week. It's going to be interesting to see how Brussels and the regulators respond to this. That's your Bloomberg Business Flash. The other big story we've been tracking, of course, over the last few days, the collapse of FTX. Now, in an exclusive interview, Binance CEO CZ Zhao told Bloomberg's Haslinder Armin about what the company has discovered and what they saw when they looked into FTX's books.
It became very quickly there was a lot of funds missing, like to the tunes of double-digit billings. I couldn't trust any of the information in the data room. Like that's a virtual data room, basically like a cloud drive. I couldn't trust any of the information. So I don't believe any of the information we got was accurate or precise. So that made the process a lot more difficult. But we don't have full access to the FTX books or their trading history. We didn't have that. It was a very simple snapshot of a data room.
CZ, you talked about Genesis earlier. It says it's likely to file for bankruptcy if it can't get at least $1 billion in fresh capital. I'm just wondering, are you interested in bidding for its books?
I think I don't want to comment on the specifics. I generally assume that we have NDAs in place with almost every player in the business. But Genesis publicly halted withdrawals, basically meaning that there are liquidity issues. So I believe our team is engaged with them. I don't know all the specific details, but there's different numbers floating publicly, and there are different numbers we get like through direct private channels. Also, one of the tricky parts in this industry is whenever you talk about a US dollar number, that number changes every minute with a volatility in crypto prices. So I think our team's engaged. We're not sure. I'm not sure right now to what extent we will or will not do certain things. So I don't know all the details.
There is a lack of trust, a lack of confidence in the crypto industry right now. Can the industry survive if Genesis were to go bust?
Oh, the industry will survive. The industry will have no issues. There will be pain whenever one player goes down, but Genesis probably has less than a couple $1 billion on their books.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
It would be good to have a gas price cap. The gas price cap, which is in the document currently, doesn't satisfy any single country. It's a kind of joke for us after so many months of discussions and proposals.
The proposal that's on the table now regarding the market mechanism is flawed. There is a lot of risk for damaging the energy security of supply and also for the stability of the financial market.
European Council gave us clear instructions that we have to take care of possible risks, and we have done so. Of course, some risks do remain, but this proposal has been designed in the way that it helps us if there is another time period like we faced in August. But at the same time, it will not be triggering the intervention to the market unless it is really necessary.
EU officials talking about the debate surrounding the gas price cap that is currently being debated in Brussels right now. The officials are basically, those that are talking in Brussels, the energy ministers have agreed to postpone approval of a package of emergency measures to deal with the gas crisis. Nobody can agree on what, A, the objective is here, and the best way of dealing with it. This whole idea about a price cap on the gas price does seem to be sort of fading. James Waddell, head of European gas at Energy Aspects, joining us now. James, what's your best read of the situation right now?
Well, going into this meeting, you had very divergent positions from European countries. Some of them, like Poland or Greece or Spain, really pushing for extremely low price caps, effectively to structurally lower the price of wholesale gas within Europe. Which, given the supply-demand fundamentals that we're seeing, is tantamount to basically wishful thinking. And then you had others who were looking to just eliminate price spikes, and that was really more the position of Germany and the Commission itself, where they've said we want to put a safety ceiling so we don't get a run-up like we saw in August, but high prices are still necessary to diminish demand and to ensure security of supply.
Are we now at the position where those that are debating this price cap have realized the impact of their policy? There doesn't seem to be much input from the market, from people who actually trade gas, who actually supply gas. And I'm wondering whether or not kind of expectation and reality are now colliding.
Well, that's a good point. And the Commission itself, when it put forward its proposal, said that the ability to conduct a lot of the required consultations with the market have not had enough time to really run their course. A lot of people in the trading community do not see any of these proposals being remotely sensible. And really, it's sort of a best case that we have a cap which is very high, because if you do get meaningful intervention, you are risking what is, a very well-traded derivatives market, which, many billions of euros at stake here. And you're also risking security of supply. You're risking having too much demand, actually worsening the crisis as you go forward in time. So from the trading side of things, people don't want the price cap in.
Okay, if we're not getting a price cap, if we don't get a workable, useful price cap, what other options are there?
Well, effectively, we need to sort out the structural issue with the European market, which is that we've lost about 30% of Russian supply, 30% of, overall European supply in the space of a year, and we haven't had the demand destruction necessary to counteract that. So all we can do in the very short term is to work on that demand side of the story. And of course, in July, when the Commission first went to the market and said, can each of these individual countries come up with their own proposals for reducing demand by 15%? A lot of the same countries which are promoting a price cap were saying, actually, we're not going to reduce demand by that much. We've got a derogation. But that realistically is the only solution in the short term for getting through this. Now, we've done a very good job of letting prices do their work of eliminating demand. But if the governments had stepped in more and actually managed some of that demand destruction more actively, we probably wouldn't be looking at such dire consequences for industry as we've been seeing this year with huge curtailments in steel or metals or ammonia manufacture. It's really more about shifting the problem of demand destruction more into households where it's less economically damaging and coming up with the right incentive mechanisms to do that. We've seen some encouraging proposals put forward by Germany and the Netherlands, where effectively you can get a certain amount of your supply guaranteed and a low price. But then if you start to really ramp up to 5-year averages or even more, then you start to pay more for that.
One of the other ways, and this is an interesting conversation that I always have with European officials when we talk about this, one other way to maybe cap prices would be to have longer-term contracts. If you talk to the suppliers of longer-term contracts, the United States, Qatar, etc., they talk about the fact that they are willing and able to supply gas to Europe at significantly lower prices, but it needs to be on a longer-term basis. How far away do you think we are from that, of Europe admitting that basically it needs to sign 7+ year deals, probably longer than that, and that would cap the price?
Well, you can always go back and negotiate a lot of your contracts. I mean, if you look at the Norwegian contracts, they got indexed to spot prices many years ago. So you can go back to the Norwegians and say, actually, we want to structurally lower some of those prices for existing contracts into the European market. And you probably wouldn't get that much pushback given where we've gone in terms of prices. But in terms of new contracts, you're waiting for that next big supply wave to come online, really about the middle of the decade. Now, the trouble with that is when you're looking at 2025 and that start of that LNG contract, for example, most LNG contracts, which are being signed with Asia now, we've seen some very long ones going for 20 years. Now, this is very attractive to a developer. But of course, 20 years running from 2025 is starting to be a problem when Europe is already trying to eliminate gas within the balance because of net zero targets. So this is the friction that we're facing. Now, if it's US supply, it's actually easier than Qatari supply because most of that US supply is divertible. So if you don't need it in Europe in 10 or 15 years' time, you can start to sell that back to Asia.
In terms of where we are now with the weather, this is obviously going to be the big swing factor over the next few weeks and months. We have had a mild autumn. What is the expectation now? I'm sure you guys see longer-term weather forecasts. Is the expectation that Europe is going to be okay with current supplies this winter, given what we're currently projected to see in terms of temperatures?
Well, yes, we've been very lucky so far, and actually what that's done is just left a huge amount of gas in storage really throughout October and into November. We've also had a lot of LNG cargoes really parked outside of Europe, which are effectively floating storage for delivery over December and even into January. So we're actually looking very good for this winter. And you would take a lot of very cold weather, 10% colder in Europe and in Asia, to really start to move the dial and actually get us down to something like the Beast from the East scenario in 2017, 2018, which was a particularly low level of storage carryout. So for this winter, we're looking fairly comfortable. The dilemma, of course, is next year in terms of having so little Russian gas coming in on an annualized basis and having to refill storage for the winter 23-24.
And are Germany's going to put these floating regasification plants in? I understood that one of them docked, I think it was yesterday or the day before. Are those facilities now in place?
So we're expecting about 3 regas terminals to be starting up in Germany, basically over the start of December through January, and that's going to be adding a lot of regasification capacity. And this is in addition to the Finnish terminal, which is starting up around year end as well. We've added a lot of capacity in the Netherlands. Europe is slowly but surely building out that capacity to be able to push the gas into the places which have been most deprived of their Russian supply. And of course, this is an infrastructure bottleneck, which has been driving these huge spreads within the European market and these huge spreads between pipeline prices, the TTF, and DES prices for delivery of LNG to Europe. And this has caused a lot of confusion in the market about why LNG prices in the water are so much lower. It's mainly because of this infrastructure bottleneck in getting LNG into the pipeline. This should be relieved mostly by next year.
James, great to catch up. Really useful insight into what is happening here. James Waddell, head of European Gas at energy aspects. Thank you very much indeed. Coming up, we're going to hear more from energy ministers meeting in Brussels. Estonia's Minister of Economic Affairs will be joining us next. This is Bloomberg.
NEC was started under President Clinton, and Bob Rubin was the first person to hold that job. Can you explain to people what it actually does and what the NEC does day to day? When, for example, who's in the NEC, who's on the NEC, what is your job actually to do?
So the National Economic Council, the job, the mandate, the mission of the organization is to coordinate economic policy across the executive branch and across the cabinet to make sure that the president is getting the benefit of when making decisions of his entire economic cabinet, and also that the economic cabinet is getting clear direction from the president as well. So that two ways. So it's a coordination function. On the NEC itself are all of the relevant cabinet members, the sort of core economic team, OMB, Council of Economic Advisors, Treasury, but also Secretary of Labor, Secretary of Commerce. My team, the NEC team, is a small team within the White House that is, our job is to do that coordination across the range of economic policy issues.
Now, you were the deputy in the Obama administration at the NEC, now you're the director. Which NEC worked better, the Obama administration one or the Biden one?
Well, on the issues that I worked on in the Obama administration, it worked very, very well. And the current NEC works very well as well.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues. We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
Okay, let's keep you up to date with news from around the world. Here is the first word news. In China, daily COVID infections have risen to a record high. The country reported almost 30,000 new infections on Wednesday. The recent surge comes at a critical moment for leaders in China. They have to decide whether to tolerate some spread of the virus or revert to strict COVID-0 restrictions that could ultimately hurt the economy. In Ukraine, a barrage of Russian missiles has knocked out power for millions. The attack came at a time when temperatures are now below freezing. In a virtual appearance before the UN Security Council, Ukraine's President Volodymyr Zelensky called the missile assault a clear crime against humanity. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Okay, this is Bloomberg Markets. I want to take you to Brussels, where a huge debate is taking place about energy and how Europe needs to protect itself from energy spikes. Let's get over to Maria Tadeo at the EU Energy Ministers meeting in Brussels. Maria.
And Guy, that's a very polite way to put it, because today this has been a very intense day here in Brussels. And to debrief, I'm happy to say we're joined by Estonia's Minister for Economic Affairs, Rita Sikkut, who is joining us from the meeting. And based on what we hear, there will be another meeting December 13th. Some now suggest this is turning into a farce. Others say this is the way Brussels works. Nothing is agreed until everything is agreed. How do you see this?
It was a very intense meeting today, but I would never call it a farce. Actually, we had a political agreement on solidarity measures. For example, joint gas purchases, very important to prepare for the next winter, and fastening the permitting process for renewables, extremely important in the longer term. We need to have local, affordable energy with a small ecological footprint, and this is the only way to achieve it. And quickening permitting process, we need a pan-European measure. It can't be national. So the agreement was there, but the controversial issue, the gas price cap, indeed, the positions are very diverse, and it's difficult to find a compromise in 2 weeks, but I believe we can do it.
But in simple yes or no terms, would you want to see this price cap at 275 euros? Is this a good idea in your view?
I think it's the general impression that we need to do something to tackle the very high or extreme price hikes. So a price cap would be okay on the level of 275. But in general, Estonian position has always been that the security of supply is paramount. We cannot threaten the security of supply. If needed, we have to pay higher price.
So it's supply that matters over the price cap. But what do you say to some of your colleagues who say no? Either there's a price cap that actually works, or we're not agreeing to the rest of the package that you say is just as important.
We cannot achieve a very low daily price for consumers, domestic consumers, industries, that affects their monthly bills through a price cap. Price cap has to be a measure to tackle the extreme hikes, but if we want to have effect on monthly bills, benefits are the solution.
And can I just ask you to wrap the idea of the gas, because there's another cap going on here too, but on the gas, what would you say to some that argue the Commission is biased in favor of Germany? That's why they've set out this criteria, they've made it 275 euros and created a cap that probably is never going to be triggered. What do you respond to that?
Difficult to say. I'm not that objective. I'm close to the Germany's position. But in general, we need a decent compromise. If we agree on some kind of price cap that doesn't threaten the security of supply, I think a very strong message for the market in terms of decarbonizing gas in general, like coming off fossil gases in 10 years. We should be able to send this kind of signal as well.
And by December 13th, if I ask you, will there be a deal, yes or no, including the 3 pillars, including the price cap? What's your bet?
Estonia is working to achieve a compromise because keeping unity in this situation is paramount. We cannot let Russia divide us on energy.
And let's flip into the Russian oil, because that's the other debate that's about to start today. As you know, there has been this idea that it could be capped between $65 a barrel to 70. Reports, including Bloomberg, suggest that the Baltics, so your country, and the Poles are blocking this. You say this is too much. Will there be a deal of this Russian oil cap at $65 a barrel today?
The only thing connecting the gas price cap that we just discussed and the oil price cap is the term price cap. Otherwise, the issues are completely different. The oil price cap should be as low as possible because we are discussing only Russian oil and we cannot finance Russia's war in Ukraine, so the lower the better.
So if I understand this correctly, because this is important, what you say is 65 for you, it's not an acceptable offer. It has to go lower. So what's the price that you'd agree to?
Estonia still thinks that unity is the most important thing. If the unity can be achieved on 65, well, we might be able to compromise, but we have to try harder. We have to try agreeing on a lower level. The Polish has offered $30 per barrel, maybe something between 30 and 65.
That's where you want to see it, 30 and 65. It's a big range. Potentially, where's the compromise then? It's a big range.
It is a big range. We are not fixed on a specific number, but rather a low price to try out the finances for Russia.
And what do you say to those who say, ultimately, this changes nothing? If it gets agreed at that range, 65, I mean, this changes nothing. And Russia, this is a political war. This is not about the energy. Vladimir Putin has a political intention and will continue. What's your response to that?
Oh, there is no economic or diplomatic solution to this war. Ukraine needs to win, and we have to provide the weapons and ammunition. Everything else is done only to support Ukraine's win.
And can I ask you about the situation in Ukraine? Because what we hear today is that this is now dramatic. The weather is getting very cold. The energy infrastructure has been destroyed in massive ways. And of course, we hear reports, people that have no water, no electricity. This is happening in the heart of Europe in 2022. How can you help Ukrainians deal with this winter that looks incredibly complicated?
Yes, we had at the beginning of Energy Council intervention from Herman Halvchenko, the energy minister of Ukraine, who described the situation and the attacks during the last couple of days. And this puts everything in a different perspective. We are discussing a gas price cap or solidarity measures, as these are the most important things. The challenges that Ukraine faces this is something that we cannot even imagine. We need to provide the equipment that they could restore their heating and electricity systems as much as possible to support the brave Ukrainians to survive this winter.
And just very briefly, some believe a cold winter will break the spirit of the Ukrainian people. In your view, very quickly, will that happen, or are they going to continue to fight? You know this country very well.
No, it won't break the Ukrainian spirit, and we have to help them surviving the winter by providing the electricity and heating and equipment they need to restore their systems.
Well, Minister Sekut, thank you so much for joining us today on Bloomberg. We appreciate, of course, your time. And, of course, we'll see you on December 13th because, guys, as you can see, no breakthrough today on the gas. We're waiting on the oil, but this conversation continues.
Maria, I think it's going to be a tricky one to solve. Some really big numbers being thrown around there, some really big spreads. Fantastic interview. Thank you very much indeed. That was, of course, Estonia's Economic Affairs Minister joining Bloomberg's Maria Tadeo in Brussels. Coming up, we're going to stick with the Brussels theme. Twitter has lost its entire Brussels office. We're going to look at how that will affect its dealings with European regulators. That conversation next. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Welcome back to Bloomberg Markets. Happy Thanksgiving. So let's turn back to Twitter, perennial subject. apparently it has lost its entire Brussels office. Now, it wasn't a big office to start with, but it had been key in engaging with European regulators. Only had 6 people in it. It was cut down to 2. Now they've left as well. Let's get some details on the impact that this could have with Gillian Deutsch. Gillian, the regulators in Brussels were already signaling that they had issues with what was happening at Twitter. I'm assuming that this is only going to exacerbate matters.
Yes, I mean, even when Elon Musk was saying he wanted to buy Twitter, we saw some interesting interplay between the European Union's Internal Market Commissioner Thierry Breton warning Musk, saying, sure, you can come in and start this whole free speech approach to Twitter, but you have to follow all of the European Union's rules. One of the most important rules that we're seeing come up is the Digital Services Act. And in this legislation, which companies like Twitter have to comply with next summer, this gives Brussels unprecedented powers to basically tell big tech companies, 1, they have to take down illegal content, and 2, they have to do more to handle content that might be legal but harmful.
Is it just Brussels that has a problem with this, or are other European capitals growing concerned as well? It does seem as if Twitter is losing significant numbers when it comes to the safety side of the platform.
Absolutely. I mean, the Digital Services Act is coming up, and so we have people in Brussels very concerned about that. But they also have to comply with rules already on the books. That, of course, includes the infamous data protection rules, the GDPR. They have a massive office in Ireland, and we also saw a big exodus from there. One of the most noteworthy people leaving was their data protection officer. This prompted Ireland's data watchdog, to say, hey, what's going on in Ireland? Are you guys still going to be able to comply with the GDPR? We have seen Twitter say, yes, we have an acting data protection officer in this person's place. We will be able to follow that. But in both these cases, yes, Musk is aware of the rules from the EU, but the really big question is if he has enough staff to actually comply with them.
What if he doesn't? What are the penalties that could be imposed here?
We could see some massive fines from the EU. Twitter's already run into issues with GDPR 2 years ago. They were fined millions for breaking the GDPR. And in the digital services case, those fines could be even more. If companies like Twitter continue to offend the rules and break the rules, they could also be banned from operating in the European Union entirely. Now, that's obviously kind of the nuclear option, but really one of the problems we could see, regulators coming in and raiding their offices in San Francisco to make sure that they're doing what they're saying they're doing. So we could see some big fights coming up with Brussels.
Looks like it's just getting started. Gillian, thank you for updating us and informing us. Gillian Deutsch on what is happening with Twitter. Okay, coming up in the next hour, we're going to speak to the Riksbank governor, Stefan Ingves. He is stepping down, but delivered today a 75 basis point hike. Looking forward to that conversation. Stateside, of course, it is Thanksgiving, and the Macy's Thanksgiving Parade in New York City is firmly underway. We're back in business. The weather looks amazing. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
So, U.S. markets are closed for the Thanksgiving Day holiday. Alex Steele is currently cooking turkey, I understand. We look forward to hearing reports of that. Big day shopping tomorrow coming up. But we're still here, and we've got some top market stories that we are following for you at this hour. The boss of Binance telling Bloomberg that he will amass at least $1 billion for his industry rescue fund. Sisi Zhao also indicating that he'll make another bid potentially for the bankrupt lender Voyager. The Fed pointing to a rate hike slowdown. The Bank of England says it will raise rates regardless of the pain. And in Sweden, the Riksbank delivers another 75 basis point hike. We are going to hear from Governor Stefan Ingves very shortly. And China's COVID cases hit a record high, exceeding April's peak. The news calling into doubt any exit from strict pandemic curbs. From Washington, I'm Guy Johnson. As I say, Alex Steele has the well-deserved day off today. It is, of course, Thanksgiving in the United States. That means that we are seeing light volumes really across the world with the US markets out. Stocks in Europe and Asia up, though, on the latest signals from the Federal Reserve. The minutes came out yesterday, 2 p.m. Eastern, and what they signaled was, well, to be honest, the Lael Brainard is in the ascendancy. The doves seem to have the argument at the moment. We are certainly migrating towards a 50 basis point high world. That certainly seems to be now locked in firmly for the December meeting. Markets in many ways already knew this, but confirmation always well received and risk assets responding appropriately. What we've also seen is the dollar coming down as a result of this. You've got the Japanese yen up by 1%, the British pound now trading at 121.43. Can't remember the last time I saw these kinds of numbers. And European markets more broadly trading quite positively on the equity front. Joining us now to discuss all this, Bloomberg's Christine Aquino. Christine, the minutes. I read them. There wasn't that much of a surprise in anything that I read. We are migrating to a 50 basis point world. The dots had already signaled that. The last press conference had already signaled that.
Yes, Guy, but I think there's something to be said about actually seeing it on paper.
The reality.
Exactly, and getting confirmation from it, because we did get a whiff of that at the actual November meeting, but now we're kind of getting the reinforcement that markets were probably looking for in terms of strengthening this idea of a recalibration in Fed policy heading into 2023. I think there are a couple of nuances that were quite interesting there. Their description of various policymakers seeing the peak as higher than previously expected. That's definitely something that you don't normally see. Exactly. You don't normally see that. And I think that's when the Fed is wanting to introduce a little bit more ambiguity to it. And then also the recognition of those recession risks on paper, 50-50 chance, really makes an impact here.
But coming back to that point about the fact that rates might ultimately, the terminal rate may ultimately have to be higher, this is highlighting an increasing debate within the Fed. The Fed is no longer unified in the approach that it wants to take.
Absolutely, Guy. And I think that really tells us that 2023 is not going to be a one-way bet in a lot of ways anymore. You know, I think in some ways, 2022 was very clear for investors, right? It was a year where you bet on the dollar, you bet on yields going higher and stocks weakening. But 2023, there's going to be a lot more divergences and nuances, I think, in markets, especially, as you say, there's a little bit more ambiguity in terms of where the individual FOMC members stand.
Do you think the bulk of the FOMC has now moved slightly more? I'm just kind of wondering where the center of gravity is right now.
Well, we know who to be watching for, of course, is James Bullard, a key bellwether of Fed sentiment. But I think overall what we've heard from policymakers recently, definitely still the overarching message remains clear, right? That they want to keep raising rates. They want to hit that peak rate eventually to fight inflation. But then the means to which they get there differing slightly now. And I think you're correct in kind of observing that it seems to be a bit more of a shift now among certain members where perhaps they don't need to get to that peak as soon as previously thought. Maybe they can go a little bit of a slower pace, and that's enough to cheer markets, it seems.
My production team are going to laugh about this next question, but has the buck stopped? Is that it? Is the dollar done? Is the peak in?
The buck has certainly paused. That's what we know for sure. I mean, you know, it's not enough what we've seen in terms of the dollar pullback to completely erase this year's gains. I think it can still fairly be called king dollar at the end of 2022, but certainly it does seem like it was primed for a bit of a slowdown. I mean, apart from what we're seeing in terms of Fed dynamics, there's also just positioning in the dollar itself, right? It has become a bit of a one-way bet, especially because it's steamrolled over every other currency this year. And it just seemed like all those things combining together made for a good pausing.
What does it mean for other central banks? What is this? If the Fed is going to switch, if the Fed is going to downshift to 50 basis point hikes and potentially 25 basis point hikes next year, what does that mean for the ECB? What does it mean for the Bank of England?
Well, on the one hand, I think it might give them room to catch up. That was part of the issue, I think, when it comes to that divergence between the dollar and the rest of G10 currencies, is the fact that everyone else was trying to catch up to the Fed. The Fed was really just way ahead of everyone in terms of getting those rate hikes deployed. But then on the other hand, it could also be a signal to these other central banks. I mean, we talked about this, right? The Bank of England potentially saying that maybe they're not going to be doing as much as markets expect. And it affirms that sort of view. Whether that actually does solve the problem of inflation, specifically in the UK, is another question.
It's interesting because the language seems to be becoming a little bit more hawkish now from the bank. Catherine Mann speaking today, Dave Ramsden, chief economist, speaking a little bit earlier on, basically indicating that he felt that actually the bank needed to be more aggressive at this point. The communication from the Bank of England does seem to be quite mixed at the moment, if I'm being polite. And the idea was that the bank was going to steer us away from the extreme market views on where rates could ultimately go. But now we're seeing data that suggests that the inflation is probably going to be more sticky, that the bank might actually have to go further than the bank itself was suggesting.
Yeah, that's very much a possibility, Guy. But I think, you know, as you alluded to, at this point, I think investors are pretty used to the Bank of England kind of saying one thing and then eventually having to backtrack on that. But definitely watch the space. I think depending on how the data plays out and how markets how much they heed the Bank of England's previous message, I think there's a lot of room for things to shake up here before the end of the year.
Pinches of salt may be applied. Christine, thank you very much indeed. Fantastic as ever. Bloomberg's Christine Aquino. As we've already said, we're going to stick with the central bank theme. Coming up, the Riksbank Central Bank Governor Stefan Ingves, his final meeting today, delivering a 75 basis point hike. We will speak to him next. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
So Sweden's central bank, the Riksbank, today raised its benchmark interest rate by 75 basis points and signaled more tightening is needed to tame inflation. That brings the key rate to 2.5%, which is the highest level we've seen since 2008. Governor Stefan Ingves joins us now from Stockholm. Governor, thank you very much indeed for your time. 75 basis points was the hike that you delivered today. Was that an easy decision?
I do think so. It wasn't all that difficult. I mean, on the one hand, 75 basis points, that's a lot compared to what we normally do. But on the other hand, if we look at the numbers and look at underlying inflation, the way we saw it in September and compared to where we are now, the underlying inflation is actually higher. And that meant that it was very reasonable, in our view, to raise the policy rate.
You've signaled as well, and I can understand why you've done so, given what you've just said, that there will be further rate hikes to come. How should investors be thinking about those rate hikes, and ultimately how far you are going to have to go if inflation is remaining as sticky as you suggest?
Well, first of all, we expect inflation actually to come down quite quickly next year. But at the same time, we need to do a little bit more. But it's also incredibly hard to pass judgment on what is the sort of some kind of a proper rate, let's say 2 or 3 years out. And that's why this time we actually chose to publish a policy rate path, which is flat. And that doesn't mean that the policy rate will stay that way for, let's say, 3 years. It's more to indicate that there's a lot of uncertainty out there. And clearly, if inflation goes up, and suppose we were to be wrong in our forecast, then, well, then the rates would have to go up even some more.
In terms of past hikes that you have delivered, how are you thinking about the cumulative effect that they are having?
Well, first of all, I do think that it makes sense on our side to be a little bit on the slower side compared to what we have done in the past, because now the policy rate has gone up by 2.5% in 7 months. And that is quite a lot. So a bit slower would be just fine, because then we can see what happens in the economy as a whole, and to what extent what we have done really sort of takes hold. If you look at our projections, we assume that the Swedish economy will be shrinking next year. And also consumption will be affected, and consumption will fall, which is not at all that surprising when people have a lot of debt, because then you have to pay on your mortgages. And with inflation being way too high, that is also reduces your real income.
Yeah, you've run through the effect that is certainly being seen very clearly via the mortgage channel. Governor, have you been surprised how quickly the housing market has rolled over, though?
No, not really. I mean, we have argued that house prices will go down about 20% from peak to trough. Whether we are right or not, time will tell. But so far, I think our projections have been reasonably okay. And we have actually, for for a long, long time said that there will be a day when policy rates and other rates go up. Be mindful of that also in an environment when we were at zero. And now we got to that point, and then of course that will be felt, and felt by many.
So what I'm hearing, I'm just kind of thinking about what you just said. What I'm hearing is that you are comfortable with the moves that we've seen thus far. What would make you uncomfortable?
Well, I mean, one thing that would really make us uncomfortable is inflation does not come down the way we expect inflation to come down in the course of next year. And we actually, way back in the monetary policy report, have an alternative scenario that shows what happens if inflation does not fall the way we expect it to fall. And then, of course, the policy rate would go up even higher.
Yeah. More specifically, within the housing market, is there anything there that would make you uncomfortable? What's the worst case scenario that you're looking at? What would that sort of worst case scenario look like? And would that be something that you're uncomfortable with? How far can the housing market fall before you start to get worried?
That's, of course, very, very hard to say. And I think an important point here is that what the credit market looks like when it comes to borrowing on your house differs from country to country. And in our sort of legal framework, people actually mostly do quite a lot when it comes to paying your mortgage. So the first round effect would not really be in the housing market as such, despite the fact that prices are falling. It really would be cutting back on consumption, because then you have to, if you have to pay your mortgage, you will have to consume less in one form or the other. And that, of course, would mean a more prolonged downturn than what we have in our projection now. And unemployment would, of course, as a consequence of that, go up.
You've talked in your reports about the commercial real estate market. You've highlighted